we get started here, as I mentioned, I'm the former director of manufacturing at Ray. So, as I think all where you focus, you're usually successful. And so here at Ray, we're really no different. And as we look at our firm, manufacturing distribution makes up 20% of our revenue. And it's our biggest industry segment that we serve. And so many of you know Kyle Stemple. He was the director of manufacturing a couple of years ago, then Dustin Raber, and now myself. And while I think we were able to do a good job, all of us have our own clients, our own other responsibilities outside of really servicing you guys as manufacturers and the different solutions or the different issues that you work with. And so we felt the need that we needed to kind of take the next step and hire someone who can do this full time. And so really get out and help make sure we're doing the right things and providing what is needed for our clients. And so with that, really proud to introduce Ryan Brickwood. He started with us on Monday, so he's still the newbie. So so make sure you ask him a lot of questions, put him on the spot, but feel free to introduce yourself to him. He'll be coming around and mingling around later. Ryan comes to us from the J.M. Smucker Company. He was there for 17 years, 13 of which was heavily involved in plant operations, plant finance, corporate cost accounting, and acquisition integration. So I'm going to turn it over to Ryan. I'll let him introduce himself a little bit more, but thank you all for coming.
Thanks, Andrew. Actually, before I get started, there's a birthday in the house, so we're going to have to actually, he's going to have to stand up for us. So Sam, please stand up. It's birthday today, so everyone wish him a happy birthday. All right. Thanks, Ryan. No, sorry. He shouldn't have told me that. That's his first mistake. Well, welcome and good morning. As Andrew mentioned, this is my first week of work. So today completes the first week. So hopefully I can finish the day all right without any issues. But I am leading the manufacturing distribution services here. And a little bit more background. Yeah, I was at Smucker's for 17 years, and Lonnie Miller can attest to this. So keep me honest, Lonnie. But I started in many roles in finance there, mostly around costing and operations accounting. And then I relocated and went to their Memphis plant manufacturing site, and they did jams, jelly, preservatives, and toppings. So I was the plant controller there. And then I relocated back to corporate and had various roles, and I became an operational controller. So over our coffee operations, so I was over 8 manufacturing sites at corporate. And I did 5 integrations along the way, from Folgers all the way to Big Heart in different roles. And Big Heart was our biggest acquisition, and I led that with working with the team, doing controller, training the new controllers, getting them up to speed on inventory, costing, bill of materials, stuff like that. And so Andrew mentioned 13 out of my 17 years is in manufacturing operations support. In the last 4 years at Smucker's, I transitioned to sales and marketing support. So focusing on LRP, which is long range planning, forecasting, budgeting, a lot on pricing. So I did a lot with margins, looking at margins, gross margins, segment profit. So on the front end, so I got the front end and the back end for the manufacturing cost. One of my goals here at Ray is to take manufacturing to the next level. And I'm looking forward to partnering with you guys on the next adventure. Looking at digital, so dashboards, right? Technology, looking at lean manufacturing, loss analysis, driving out loss, and then costing and financial analysis. Those are the kind of the goals that I'm looking at as I take on this new role. And then lastly, I'm looking over the agenda. I can't take credit for it, so if it's good or bad, Andrew and the team has provided that. But a lot of these topics today is prevalent to the industry today and in your business. Even at Smucker's, I'll take a few of the examples. The R&D credits and cost seg. We look at that. Being at New Orleans, we had coffee operations. They were growing and expanding, new buildings, new jobs. So looking at opportunities there. And then I don't want to steal Dustin's thunder, but inventory management. The importance around having the right inventory levels, especially with demand and supply. All the supply chain issues that we've seen on the front end, getting inputs in, getting product in, getting your variable input manufacturing costs into the system. That is an optimal, important topic in today's world. Today's changed. A couple of years ago, it wasn't like this, but now it's, you always got to be changing, evolving. And then lastly, digital transformation. Very important to, have those dashboards, real-time data, so you can be proactive versus reactive, right? So you can have the data in front of you to make real-time decisions. Because a lot of times, after the fact, you go, okay, what should we have done? Lessons learned. But if you go on the front end and see it and course correct before something goes wrong, then you can say, okay, I do this differently, then this is going to help our company, our bottom line. So those are the things, kind of my vision out of the gate. But again, first week, so I'm still learning. It'll take me some time to get there, but I want to meet a lot of you guys today and see what I can do to provide, a future service for you guys. So with that, I get the pleasure of introducing our next speaker. So Brian Wages, and I got to look at this because I just met him about 30, 40 minutes ago. So I don't have his bio memorized yet, so I apologize. But he's located in Atlanta, Georgia, him and his family. He comes with us over 11 years of state and federal tax credit specialist, where he's been responsible for supporting over hundreds of companies on tax credit savings. The only problem I have with Brian is he's a Georgia Bulldog fan. And I love Ohio State, so most of you are in here. We have a Michigan person in here too, so we won't bash him too bad. But okay. So I'm wearing the red for Ohio State, not for the Georgia Bulldogs. So with that, I'll introduce Brian Wages.
Hey, thanks, Ryan. Thanks, Ryan. Thank you to the Michigan fan for making me not the most unpopular person in the room. My name tag says STG, Specialty Tax Group, but we are a part of Ray & Associates. We do the specialty tax work for all of the clients. And the reason I'm here today is all these tax laws for the tax credits were put into place for manufacturers. So it's just a perfect opportunity. I was very excited when I was asked to come speak today to talk to you a little bit about how we could possibly save your company in taxes. So maybe that'll make having the 7:40 a.m. time slot not put you back to sleep if you can learn how to save a little bit of money in taxes. Yeah, so there's the bio. I think Ryan hit on most of this. Even though I am in Georgia, I'm up here in Ohio, along with the founding principal, John Hanning. He was here last week, so we have a lot of connectivity here in person. We like to come up here in person and meet with clients and meet with the Ray team. Don't look at the Georgia Bulldog and think that we're never around. We like to come around and meet with clients in person. So our three main services, we call it a three-legged stool. That's why there's the picture of the stool on the screen. Cost segregation is our number one service. Then the research and development tax credit, which I'm personally over at Specialty Tax Group, and then green energy incentives. That's the third leg of the stool. So these are the foundational service lines for STG. Now, I do have the title of this presentation was Cost Seg, R&D, and More. So I did throw some additional content in here for different programs and services that we'll go over as well. But we're going to start with these three because they're the core services for what we do. So the first one is cost segregation. Now, admittedly, this is not my specialty. John Hanning, who's the founding principal, he's done this for 20 years. He has so much experience with this particular service. He usually does this portion of the presentation, so I will try to attempt to fill in for him as best as I can. But cost segregation is a service that we provide where we go into, we look at property, and what we're trying to do is take that 39-year property and 27.5-year property and recategorize those assets into short life property, 5, 7, or 15 years. And we do this through a detailed analysis of the hard and soft costs associated with the construction of that property. So when we look for these opportunities, it's with new construction, buildings, leasehold improvements, or acquisitions. Those are the three scenarios where we find the opportunity for cost segregation. And the idea of cost segregation is a time value of money. So we can go back to a placed in service date as far back as 1987. Now, we wouldn't want to do that because a part of this, the time value of money, that formula is time. So going back that far, you're not creating the benefits that you would need in order to do that. So the primary goal of cost segregation, depreciate those assets faster. All the identify that property that's related to the cost that can be depreciated into that 5, 7, or 15-year tax life. And what that does, it creates the cash flow for your business. The net present value creates that time value of money benefit. So accelerating that depreciation accelerating those tax deductions creates that time value of money concept. So saving $1 today is worth more than saving $1 in 27.5 or 39 years from now. So in addition to accelerating the deductions and increasing the cash flow, it also allows for more accurate bookkeeping for fixed assets, and also the ability to utilize partial disposition election moving forward. So that's the goal and the benefits of cost segregation. So what we're looking for to trigger, so we like to use the word trigger for identifying an opportunity where it makes sense to take a look at these different services for us. So for cost segregation, if it's a taxable entity, it's profitable, and you're looking to improve cash flow, combine that with the situations on the right side of the screen. It's a newly constructed facility, expansion, acquisition, recently acquired, large amounts of CIP, many locations, and if there's significant long life property. That's the scenario or the formula where it makes sense to look at a cost segregation study. So here's just a diagram of what we do in these studies. So all that property is initially in 39 year. And with this study, we break it down into these other buckets on the right. So that's just a diagram to illustrate what the purpose of the cost segregation is. So when I say 39 year or 27.5 year property, anything this is the long life property. This is anything that's permanent or necessary for operation of a building. So I always like to say, if you moved out, would you take this property with you? So then the answer would be no for this real property. So see, these are some of the examples of what that 39-year property would be in commercial buildings. Concrete walls and floors, HVAC, plumbing for HVAC and restrooms. So these are the examples of the types of property that would need to remain as long life property or 39-year property. Now, the purpose of the cost segregation study, we're trying to break out these types of assets, the short life property or Section 1245, tangible personal property. So these are the assets we're looking for. Every study that we do an on-site visit. We go in, we take pictures, we take measurements, we take counts, and what we're trying to do is identify and document these types of assets so that we can recategorize them as short life property. And just some examples on the bottom of those the short life property: electrical, process piping, decorative lighting, millwork, blinds, So those are the types of property that we're looking for in the cost segregation. So next, I want to just kind of go over a very simple example of a $5 million building. So the purchase price of this example is $5 million. So of that $5 million, we go in, we break out 700,000 is depreciated over 5 years, 600,000 over 15, and then the 3.7 million over the long life property. So this is just an example. That increased depreciation deductions in the first 5 years is $1.1 million. And one of the benefits of doing cost segregation in 2022 or earlier is that bonus depreciation. So, and I'll go over that more in a couple of slides. So this is the slide I was referring to earlier about the bonus depreciation, the schedule of what that has been going back all the way since 9/11 of 2001. As you can see, starting in September of 2017, that bonus depreciation is 100%, but it's going to start being tiered down starting for property placed in service in 2023. So those properties, placed in service prior to that are eligible for that 100% bonus depreciation. So, this is the last slide for cost segregation. One of the questions that we get a lot, what is the cost basis where it starts to make sense for one of these studies? And, we used to say $1 million, but because of bonus depreciation, we say like 750,000 now. But if there's, multiple buildings, maybe it would make sense at $500,000. And also, if you plan on holding the property for longer than 5 years. And really the process to get one of these cost segregation studies completed, we provide a net present value and a benefit proposal for free. We just need a few pieces of data that can be provided on this form here on the right side. Once we provide that benefit, you decide to move forward. We start gathering the data, review it, analysis, then that site visit where we come out to the property in person and take the photos, measurements, and counts of everything. We'll do that, and from that point, at 30 to 60 days, we'll get that full study report done that's designed to be full audit support for that cost segregation study. So, the first way to get started, we call this form the RFI, request for information. So that's how we could get started on a cost seg for a property. So kind of went through that a little bit fast. So if you have any questions, I can pause for a minute and before we move on to R&D. Okay, so R&D, that's as I mentioned earlier, that's what I was brought on to the STG team for, is to lead this service line. It's where where my background has been for the last 11, 12 years is tax credits, and one of those is the research and development tax credit. So these two photos in this slide, usually when people think about R&D tax credit, they think about the picture on the left where there's an individual with a lab coat and a beaker doing actual lab work. But there's so many other activities that can be included in the R&D tax credit. So manufacturers actually claim 65% of the R&D tax credits in the country. So the picture on the right is just we were touring a manufacturing facility. That's John, the founding principal, with me. And there's this manufacturer installed a robot to assist in their manufacturing process. So I thought that was just a great example of an activity that would qualify for the R&D tax credit that you may not think initially would be able to be included. And the way we determine if these activities can be included in the R&D tax credit It's a 4-part test. So here's my cheat sheet. I go by this. I always use it when we're looking at a company's activities and trying to determine if they qualify for the R&D tax credit. And I always start with the bottom right box. Permitted purpose. Is your research and development does it have a defined purpose of creating a new or improved product that has a goal of increased function, performance, reliability, or quality? So I always start there. That's the, if you're doing that first, if that activity, it meets this first requirement, there's a pretty good chance that this activity is gonna qualify, because if you're trying to create a new product or improved product with improvements in these areas, you would need to test it, right? So that checks off the box on experimentation. And if you're testing it without knowing what the result of the test would be, you pass that technical uncertainty. So really the only other box is the technological in nature. So those types of manufacturing R&D generally qualifies under the engineering component. So when I go into a manufacturing client, one of the first questions I ask, do you have engineers on staff? Because they're that type of creating what the job an engineer would do in a manufacturing company generally would qualify for the R&D tax credit. So, the first step in this process is educating clients on, okay, what activities do we need to be looking for that qualify for this credit? So here are some ideas of tasks within a manufacturing company that would qualify for the R&D tax credit. So I created this slide to just kind of get your brain flowing, thinking about your company, looking at the slide and saying, oh, we do something similar to that. So these are just examples of what would qualify within a manufacturer. And I'm not going to go through each one, but these are, and here's another photo of a robot within a manufacturing facility that we toured. So what are the steps once you are interested in the R&D tax credit? How would you get started with, hey, let's look at the different activities in my company to see if we would qualify for this credit? So that's the first step. Is we'll have a discovery meeting where I'll go over, I'll go over the cost or the activities, and we can brainstorm what goes on in your business that you think might qualify for this credit. So it'll be a brief 30-minute call. We'll brainstorm. Once we determine that there are some qualified activities within your business, we can move on to the next step. So brainstorm and qualify those activities is the second step. Also in the call, we'll discuss the costs that can be included in the calculation. So once we know that you qualify, we try to quantify what that credit will look like. And the reason we do that, we want to be able to provide you, here's what a range of where your credit will be. Here's what our fee will be. That way you have all the information that you need to make a business decision, if this makes sense financially for you to move forward. And we do have a template for any of the data that we need for that initial estimate. And those can be ballpark figures as well. So we're hoping that's not too big of a time constraint to provide this, especially this initial data where we're just trying to get an idea of what that credit would be. So once the engagement letter is signed, the project details, so those activities that we discussed in that initial call, we'll need some detailed information on those activities. And what that does is that gives us the backup we need. We're always told, when you're claiming a tax credit, you want to have that backup documentation available just in case an audit comes down the line, 3 or 4 years down the road. And we also can either do 2 different scopes for the R&D. We can do a calculation only, where we provide the numbers for the credit filing or the filing claiming the credit on the return. And we also do the full study report, which is designed to be full audit protection. No matter which scope you decide to go with, we still ask for that project information. So we'll have that backup data either way. So here are the different costs that we can include in the calculation. The biggest bucket of cost is the internal wages, 99% of the time. So your internal team that participates in R&D, that supervises R&D, and that supports R&D. So I always use the example for supporting R&D because that can be pretty ambiguous. Say you're testing a new product and you task someone to input those test results into the system. So something as simple as that, their time can be included in the calculation of this credit. The second bucket is the supply cost. This has to be raw materials used and consumed during the process. So think when you create a prototype, that the cost of those materials creating the prototype can be included. And then the last bucket is contract research expenses. So if you outsource any part of the R&D process, we can count 65% of that cost. So the one I see the most often is companies outsourcing the testing of the R&D process. So those are the three different buckets that we can include in the calculation. So when we do that initial estimate of what we think the credit can be, we ask for some ballpark figures related to these three different costs. And then when you sign that engagement letter, you move forward, we go back and get the detailed figures for all three buckets of these costs. So in addition to the federal R&D credit, there's a state R&D credit. And one state in particular in this slide is highlighted red because that's good news for everybody in this room. Ohio has a state R&D credit, one of the 36 states, and it's actually calculated very similar to the federal credit. So the good news is for us to look at the state credit, there's no additional information needed from you. So it's a very simple calculation. It's a 7% difference of the current year expenditures minus the previous 3-year average of those same expenditures. So the Ohio credit really promotes you need to be increasing your R&D activities year after year. If you do the same amount of R&D activity year after year, that credit's going to eventually run out. Another big thing to remember about the Ohio credit, it has to be applied against commercial activity tax. So sometimes that makes it non-beneficial to a client if they don't pay that. So that's something we'll ask, or I can ask the partner at Ray that's on the account if that's applicable. So this special circumstance for startup companies, this has been in the news lately because there was a added benefit as a part of the Inflation Reduction Act that was just released. So that maximum amount used to be $250,000. It increased to $500,000, which, that's great that they made that improvement. It's pretty rare for a startup to get even $250,000. But this was in the news recently. But the special benefit for these startup companies is they can use the credit against payroll tax. So worked with a couple of clients recently where they've really found that useful because as a startup, they're still in losses and they can't claim the credit unless they're able to claim it against payroll tax. So this is a good benefit of the R&D credit. All right, so there has been some other tax law updates. So last year about this time, they added some specifications on your backup documentation. So the federal credit, you can go back 3 years to claim the credit. Any of those open tax years, you can go back and claim it. However, they released guidelines that if you do go back and amend a return to claim the credit, you have to provide some additional information. So more documentation is needed to go back and amend those returns. The good news is the full audit support report that we were providing already had that information in it. So we just stress that anyone going back does the full audit, the full study report scope, so that those claims can be supported. So there is another, pending, and R&D is a little bit in limbo right now. So starting next year, it is in the tax law that the R&D expenses have to be amortized over 5 years. But there's still hope that this is going to get pushed back or eliminated altogether. It was a part of the original Build Back Better plan to push it back to 2025. As you're probably aware, 2 different representatives didn't sign it, so it didn't pass. We're still hopeful. I keep up with these different updates. We're hoping maybe after the election, something will get passed where the amortization requirement does not, or it gets postponed at least until 2025. So, I put at the bottom, how do we plan for this in the meantime? One of my suggestions, and a lot of people won't be open to this, but if it's still not settled early in the year, it still could get retroactively done. But if you're open and have the flexibility to extend your return, that would give it more time for this tax law to be passed. All right. Any questions on R&D before we move on to the next the service line? Yeah. I'm gonna come give you the microphone. Yeah.
There you go. Here you go.
There's a lot of activity around Industry 4.0 or in Industry 4.0 areas. And
Yes.
I'm kind of wondering how that might relate or tie into this.
Yes. So as a part of the regulations, we're also looking, and a lot of people don't realize this when we first talk about R&D. It's not only new products, but new processes as well, or improved processes. So I believe that would be where Industry 4.0 could come into play as qualified activities. Yeah. Any other questions? Okay. So let's go to the third leg of the stool.
Hold on.
Oh, yeah.
Talk more too about what you didn't. I don't think you hit on like what type of employees qualify as R&D wages, because that's what largely drives the expense as well. Because some people think you have to have like an R&D department and
Right.
people who are 100% dedicated to R&D.
That's a good question. Really good question. And that's when we go into a client that is skeptical that they have enough cost to, pursue this credit. Here's really the discovery part where we can show that it's something to at least look at. Obviously, we kind of talked about engineers would qualify, that R&D department would qualify, but really it's so much more than that. And within a manufacturing company, I would be willing to say the majority of the employees qualify to some extent, because the way we calculate that employee portion of the credit, we take their box 1 W-2 wages and multiply it by a percentage of their time, the year task as a whole. So you put a percentage on how much of that was dedicated to R&D. So yes, those engineers and R&D department will be 80, 90% of their time on R&D, but so many other departments will play a part in it. So like management would be a portion of their time. You can, just going off of what I've seen, management could be anywhere from 10% to 50% of their time spent on R&D. I've even seen like salespeople be a part of the R&D calculation, maybe at 5 or 10%. So really, you need to look at every department within your business, and even if it's 5, 10, 15%, those amounts add up. And obviously, the higher that cost gets, the higher the credit gets. So, and especially when it comes to the management roles, because those salaries are so high generally, at least compared to the manufacturing employees. And also, quality maintenance staff. I see those titles a good bit that assigned for a certain percentage, even if it's on the lower side. Good question. Thanks for pointing that out, because that can really maximize the credit, which is part of my job. Getting the credit completed is obviously the main part, but another part of my job is making sure we get the maximum amount for you, so throwing out ideas and recommendations after you provide something, trying to go back and find more costs. That's a big part of my job, as well as looking at what you sent and making sure there's no red flags in the data you provided, especially in relation to that percentage that you assign. So if you have someone in marketing and you assign 95% on R&D, I'm going to take one look at that and I'm going to come back to you and say, hey, that doesn't make sense. Can you tell me more about this, because I think we might need to change it. So those are two things I'll always make a priority in completing that work. So green energy incentives. The one I want to talk about today, or the main one, is 179D deduction for commercial buildings. So this is a deduction, and it's based on the square footage of the facility. So we're thinking manufacturing facilities here. Adjusted to inflation, it's $1.88 per square foot if the building qualifies on all three components. So at the bottom of the screen, you see the three components: reduced energy consumption for lighting, HVAC, and building envelope. So those are the three different components of this deduction where a building can qualify. And it's about 60 cents per square foot for each one of these components. So ideally, the building will qualify on all three of those. There has been some changes recently come out as a part of the Inflation Reduction Act. The benefit has gone up to a maximum of $5 per square foot, starting in January 1st, 2023. So for buildings placed in service at that time, or if you do a retrofit, if it happens after 2023, to be up to $5 per square foot. And there's also an additional way that the building can qualify that has been introduced. However, even though so those are the good news, the standards are also going to go up. So with all the advancements in especially in relation to lighting that have come out in the last few years, it wasn't very hard for these new buildings or retrofitted lighting to qualify. But starting in 2023, those requirements are going to be a little bit harder, but the reward is larger as well. Another good thing to come out of it, a building can be certified more than once, as long as improvements are made. I believe it's once every 3 years. You can get the deduction if you go back and retrofit the lighting. You have a question?
Yep.
Does the 179D deduction reduce the basis of the building?
No, it does not. All right, so here is the second green energy credit that I want to talk about, or the first was a deduction. This is a credit. Solar investment. I'm not sure how much this will apply, but I did want to mention it since it's a pretty good credit, and it was recently extended and made better under the Inflation Reduction Act. So I'm not going to spend too much time on it. It's pretty simple. 30% of the cost of the solar system can be claimed on this solar investment tax credit. All right, so I don't know, how are we doing on time? We're doing all right. Any more questions on green energy before we move on to the next thing? So this one is called site selection and discretionary incentives. So this is part of my background before I came to STG. I was actually in Dublin the earlier part of this week, attending a conference with economic developers for all across Ohio, just trying to get to know them, get to know some of these different incentives, because they're trying a lot of these, and it's really on three levels, and I'll get to this in a minute. But the state level, the city level, and the county level, they're all trying to draw businesses to the state and to their city. They're offering these different incentives. So when this comes into play is if your facility is looking to expand, to move, relocate, or create a new manufacturing facility, this is definitely something that you're going to want to look at, because there's many jurisdictions that are looking to draw new facilities to their area, whether that's a new build or just acquiring an existing facility. So there's really three steps of the process that we can assist with: site selection, that initial step, negotiating those incentives with the jurisdiction, and then the compliance work afterwards. So in order to get these benefits, certain promises are made to add a certain amount of jobs or have a certain amount of spend. You have to show that on the back end through compliance. Okay, so here, here are the individuals that I was with earlier this week down in Dublin. On the Jobs Ohio, that's the state level. They break it up into 6 different regions. For the most part, we deal with One Columbus, Team Neo, and a little bit of the RGP. That's really where the majority of the clients are that we deal with. So we're in contact with those groups, but we also want to loop in county and city economic developers as well. And the big thing about this negotiated incentives, you want, as soon as you're talking about relocating or expanding, you need to let your RAE in charge, your RAE partner know as soon as you can, because we have to negotiate everything up front. And the earlier you let us know, the more time we can have to negotiate those benefits for you. So here's what they're looking for when they're looking at offering some type of benefit package. Job creation is always number one. They want to bring jobs to where they're at. And I've had multiple contacts say, we're looking for 10 to 15 jobs over 3 years, and then maintaining those jobs for year 4 and 5. So job retention, what those average wages are, if they're, if you're adding 15 jobs that pay, $10 an hour compared to a job paying $30 an hour, obviously the higher the wage is gonna look better on that application. Investment, location. Is it a distressed area? If you're going to, if you're willing to go to an area that's, currently being revitalized, that might get you a better benefit as well. So here are the different types of incentives that I try to help clients get if they're, excuse me, if they're looking to build or acquire a new facility. Cash grants, that's always the number one I try to get. Cash is king, right? But so here are some other real and personal property tax exemptions. That's a big one, can be very, very lucrative. And then tax credits within this. So Ohio offers a number of different tax credits on the state level, but they have to be agreed upon upfront. So there's a number of different incentives that we can go after. Really, it's a matter of making contact with those economic developers at all 3 levels, and explaining what you're trying to do, making those commitments, and then they'll put together a benefits package based on what you can bring. I'm not going to spend too much time on this because I'm not sure, how much this applies, but we've also assisted with grant applications through the USDA. So I don't know if there's any meat processors or anyone that works with USDA, but there are grants that we've assisted clients do the application, government correspondence, and compliance with that. All right, so just kind of to wrap it up, I always like to provide the questions that you can ask to determine if any of these programs would apply to your business. So, starting with, is your company in a tax-paying position? Has your company acquired, built, or renovated manufacturing facility in the last 5 to 7 years? That would mean we would want to look at cost segregation. Does your company plan to relocate, expand, or build an additional facility in the next 2 to 3 years? That's when we would want to look at those negotiated incentives and site selection. Did your company develop a new or improved product or process in 2022? And going back to the R&D, and that can be many different ways, many different activities can be included under new or improved product or process. Has your company, and then on the green energy, have you installed or plan to install any green energy systems, such as energy efficient lighting, HVAC, or solar panels? And that's it. Here's my information. But you can also just reach out to your Ray contact as well, and they'll get us set up for a introductory call, and we can go over the specific opportunity. But that's all I have. Is there any questions on any of the programs or services that I went over? Got one?
One other question, if you want to flip back to that bonus depreciation slide too.
Which one?
The bonus depreciation reduction, that's one we didn't spend a lot of time on either. It's a big deal. Can you speculate wildly as to whether or not that's going to change in the next few years?
So this one?
Yeah.
I've heard John say this, that he's very hopeful that it does. It's constantly being talked about, kind of like the R&D tax credit. It's always a topic of discussion. I would say I'm more confident that the R&D gets changed than this. So that's why I encourage anyone to go ahead and look at it while it's still 100, because really there's no way to know, but we're hopeful. There's constant changes. In the presentation there was three or four items that have been updated just in the Inflation Reduction Act that just got passed, and most of those were no one knew that was going to happen. So it's kind of a similar situation where we're hopeful. It's certainly possible, but there's not really any way to tell for sure. All right. Anything else? How are we doing time-wise? Back to the slide, and I'll hand this over.
Good morning, everyone. Excuse me. Dustin Raber. Just before we get into this, I had one other item that Andrew and I talked about that I think he missed. New building here at Ray. We've been here almost a year now here in Worcester office. And so if any of you want a tour, we're happy to give you guys a tour. After we're done, we can break up into small groups. I know there's multiple Ray people sitting in the back and they can all give you a tour. So we're pretty proud of the building. We're outgrowing it very quickly, which is a great problem. But just wanted to let everyone know if anyone has any interest, we're happy to give you guys a tour. So my presentation today, quick caveat, we're not going to solve inventory or cash flow management today, but my goal is to just give you guys some questions. Think about it, because as a group, we sat down, the manufacturing team. I talked to Ryan this week. He's had 3 days, so he should be an expert by now here at Ray. So we're not giving him as much as he wants, but no. So the goal is just to start thinking about this because inventory and cash management is always important. But I think over the next year to 18 months, we're going to see it's even more critical. And we'll talk about why. Just a little background. Kyle and I were talking. I think this picture is probably about 15 years ago. So I think we're all slated to get new ones, but I don't know if I want to. I've expanded in multiple ways. So actually yesterday was my start of my 15th year. I'm a principal here in the Worcester office. I focus in consulting, manufacturing, and auditing and accounting. Love to hunt, fish, and spend time with my family. So I think right off the bat, I can build some confidence with you, at least with cash flow management. There's a lot of girls, isn't there? So I have 4 daughters and a wife. And so starting with some of this and planning, I have school to pay for, clothes and makeup, sports gyms and gymnastics and dance, cars, weddings, Amazon purchases, which I will say there is someone else in here that I think has the record for 16 Amazon deliveries in one day, packages. That was not my wife. So, so all joking inside, there goes my cash flow. So as we get into this now, like I said, I'm really just trying to ask some questions, get you guys to think about this because we really believe things are changing. I think you all experienced it. We had COVID. We've had other factors which we're going to talk about. So let's talk a little bit about the current state of the U.S. economy. Supply chain disruption. We all see it. We feel it. It's really the new norm. The best case scenario I've heard and read is hopefully in the next 2 years that'll start to lighten up. My comment is something will change. Rising inflation. Inflation right now is 8.3% for the last rolling year. It's significant. What are we going to do about it? How do we continue to be competitive? Rising interest rates. The Fed has went from, I think it was 0.25 at the beginning of the year to 3.25. Oh, but wait, they're meeting in November and December again. And what speculation is it's going to go up another 1% to 1.5%. What does that do to us? Well, that prime rate that we utilize in our banks follows this. So how's that going to impact us? Inflation, interest rates, economy, how do we work through this? Rising employee costs. We're paying people more than we ever have. Salary, health benefits, just everything in general. Isn't it fun to be a business owner or in a position to manage? And I hate to say it, but the possible R word, that is out there. I think we're all leery. I think there's us accountants, we're a little bit more conservative. I think we're more leery about it. But what is recession? 2 consecutive quarters of negative GDP. We'll look at Q1 and Q2. We've had it. Now, one thing I will say, reading and talking to clients, what's really combated this right now is flux of cash that's been put in by the government into our economy, employee workforce. We've had, an employee demand, which has helped offset it. But what my concern is with interest rates going up, with inflation going up, economy starting to soften in some areas. It's a mixed bag right now. I talked to one client and they're like, hey, we're having our best year ever. It's not just top line, it's not volume, it's volume and it's dollars. Next client, it's like, man, things are starting to really drop off. I really don't think we have the crystal ball to know exactly why. But with that, all these factors we're talking about is really pushing to a softened economy. The economy softens, That's why we're talking about inventory and cash management, because those are going to be critical. Any questions on this slide before I move forward? You know, how will this impact my business? Like I said, inventory and cash flow. Inventory, significant balance on the balance sheet. You know, I hear from clients all the time, I like to have a lot of inventory. It makes me feel good. You know, that's, I heard a laugh because I know we've all heard it. The problem is it eats up our cash and it can dramatically affect profit and loss if we're not managing it, counting it correctly, making sure it's an accurate number. Cash flow, it's a result of profitability, so inventory can tie into that. It also can diminish your competitive advantage. If I don't have cash, I may not be able to sit there and be strategic and be prepared when an opportunity comes up to buy another company, maybe a competitor, to bring on one of those Ryans that has a significant amount of experience and that can strategically put me in an advantage for my business, a new hire. And it can really limit your future opportunities because I'm just trying to catch up. It's hurting my business. It's hamstringing it. So we're going to start talking about inventory first. One thing that I thought would be good to clarify is I hear a lot of people talk about inventory management and supply chain management. They're not the same. And so just have a quick definition up here. Inventory management is your umbrella term for the procedures and processes that affect basically the full cycle of inventory. Supply chain is more of your flow of product. How are things coming in? When are we needing that piece of, that part or that widget to continue down the process? So as I'm talking, I just wanted to clarify those are not one and the same. A lot of you probably understand that, but just wanted to distinguish the two. But the problem is for a small business, supply chain and inventory management procedures easily blend together, which makes it difficult to split them apart or separate them. So inventory management, we were under the old adage of Toyota, just in time, that started in the 1970s, where as my part was flowing through, I just wanted that product there at the moment I need it. And we had supply chains that were ready for that. We didn't have all these other extenuating circumstances. And so, as I've been talking to my clients and I read an article, they propose just in case instead of just in time now. Again, I want to have a little caveat. Just in case doesn't mean build your inventory to a level you feel good. I would be careful there. We don't want to have too much inventory. But what they meant by just in case is, for example, if you're a manufacturer and you do a lot on the West Coast, should I be putting a plan out on the West Coast to be closer to my customers so my delivery schedules and my transportation can't hinder me getting my product out to my clients? That's an example. It can be, maybe I have a vendor that produces this one widget that I need to have to complete my parts. And now do I need 2 or 3 to make sure if that person can't get it to me, I can have someone else. I hear a lot in this community too of, we're pretty good with manufacturing. We're starting to bring some of that stuff in-house so we know we can make that part to complete our products. So to me, that's the just in case I think that we're going to start to see going forward. If we think it's going to go back to where it was before, just in time, I think we're going to hurt ourselves because that is over. I mean, trade wars, I know Andrew talked about, political. You have, China with stuff coming across seas. It's very expensive, just to try to get product over here. And so I think as the US, we need to focus more on how can we do this ourselves and not rely on other people. Are you actively reviewing inventory? And so what I mean about this is, are you looking at your inventory and seeing what's slow? Can you get information out of your system to know what is sitting there? It's, the best way is walk around and see what has dust on it. It's not moving. The reason for that is it might only be worth a small amount compared to what you purchased it for, but that's still cash. If I can sell that product, even scrap that product and get 20, 30, 40% of what it's worth and go put that into my products that are moving at a high demand, how much more could we do and how much better positioned are we? Do you prune the bottom 10% of your manufactured products? I want to see if anyone squirms or squirmishes here. As a practice, and Ray, we even look at this at times, Are you looking at what your sales are and what products are selling the best? What is your bottom 10%? Should you be building those products anymore? Most likely that's your slow moving inventory also. And could we reposition ourselves to get rid of that, because we have a lot of dynamic, people in this room that are building new things. I think Ryan made the comment, we don't want to have 100,000 SKUs. We should be keeping it in a range that's tolerable and taking off that bottom portion and bringing in new stuff that we think will sell better. This is one that I think is very key. And like I said, internally, we do this as a firm, and it takes a lot of stress off your team. It shows that you're trying to be proactive and move forward. And it just really helps springboard your firm or your business. Do you truly know what your costs are? How can we push increased costs to our customers if we don't know what those are? The days of 1 to 2 price adjustments are over. A lot of my clients have probably adjusted prices between 5 and 10 times this year already. We have to be quick, proactive, and move those prices to our customers as much as possible. It's not our fault we're getting increases from our vendors. Why should we take that burden? There's times where it makes sense. I'm not going to say everything's going to be profitable or to the margin you want, but I'll put a plug out. Ryan, Andrew, Rochelle, we have some people, Cheryl, we have individuals here. If you ever have questions on what does your products really cost you, it's always great to get a second opinion. And there's typically very few times that we don't have some good input to adjust that, because there's probably something you're missing. Any questions on any of these? Like I said, this is really not something to tell you this is what you need to do. It's just more of start fostering different minds of thinking and different ways to think about these things. Cash flow. So we'll talk a little bit about cash flow here. How are you going to manage your inventory level? So just like we talked about with inventory management, what's the right overall level? Is it 2 million, 3 million, 5 million, 10 million? How quick is your inventory cycle or your business cycle? So when I get a product in the door, a raw material, to where I sell it, how many days does that take me? And how often do I turn my inventory? Those are key metrics to really determine what is the right level to help to start to build that, because anyone that I've talked to, this is probably one of the hardest things to change is my inventory level. Everyone feels good about a certain amount, and very often that amount's probably, Bob, we've talked about it, 20, 30% higher than it needs to be. Think about if you could have 20 to 30% of your inventory as cash in your pocket right now to do something differently. It's huge. How are you monitoring your accounts receivables? I would say most clients I work with do a pretty good job of this. We don't have a lot of people that don't pay. They may extend us, and that's, I think, the concern right now. You're seeing the economy starting to soften. Are you monitoring your AR days? How long does it take for someone, when you invoice them, to pay you? Is it increasing right now? A lot of customer or clients that I'm talking to, they're starting to see that increase. To me, if that's increasing, I should start looking at my payables and how quick am I paying. I don't want to be paying in 15 days, but I'm getting paid in 45. Now I'm the bank for all of my customers, but it's not that easy. I got to make sure I still stay in a good relationship with my vendors so I get preferential treatment, or to make sure I get my product. So it's a hard balancing act or a push-pull there, but how are you looking at that? And are you using that information to make decisions, is I guess what I would say. Again, like I just mentioned, how quickly are you paying on your accounts payable? Another one, how often are we making distributions out of the company as an owner to cover taxes or other items? Are you spreading these out? Are you trying to utilize your cash flow when it's stronger to make those distributions? Versus a lot of times it seems like when I talk to some of my clients, April 15th, July 15th, or June 15th, I'm sorry, September 15th, December 15th, that's your extension payments for your estimates. That's not always the best time for cash flow. So how are we mirroring those up? And are you talking to your your Ray partner about those, and is that the best time for me to get that information? Because the worst thing we can do is be utilizing cash in different ways, but if we would have knew about that, we could have used our cash versus using a line of credit or debt, and we're paying interest on that to pay our different pieces. How are you managing your relationship with your bank? Are you utilizing your line of credit periodically? Do you have a proper amount of leverage? So these are two things that I think at the end of the day, my goal is make sure you have a good relationship with your bank and you're talking to your banker constantly. I'm seeing in some of my clients, cash flow has been great. The last 2-3 years, honestly, in this area has been very strong. People have done a lot of good things. We got PPP as extra cash too. We paid down a lot of debt, and either clients have went to their banks and said, hey, I don't need the line of credit I've had before, or maybe that line of credit got adjusted for some reason. But as things get tighter, it's going to be tougher and you're going to need that. And so are you talking to your banks now about, what is a reasonable amount? Greg, I know you're in the room. If I can ask you a question, would you typically say there's a percentage that you would see of sales? I've heard like 10% of sales might be a nice 8 to 10% for line of credit limits, or is there anything along those lines that you would mention from that side? Not to put you on the spot, but. Okay. So Greg just mentioned for everyone that's on digitally, it does drive based on inventory levels and receivable levels also. But there again, I would recommend talk to your banker, understand what drives that, and as things are changing, are you prepared and ready? And do you have the cash flow that you need? Are you planning on retaining all your employees? I think this is going to make people cringe a little bit also. The last 2 years, it's been what I call you rob Peter to pay Paul. We're stealing from each other to get employees right now, especially in the Wayne, Holmes, and Tuscarawas community. Unemployment is next to nothing. They always say there's that 4% unemployment is just general movement in the workforce, typically is what I've heard of people just moving, just in general terms. I think the percentages are right around that or below. So we really have no additional employees. The people that can be employed and want to be employed are employed right now. Well, if things start to soften, are we willing to look at our employee group and get rid of some individuals? The gentleman from GE wrote a book, Jack Welch. He was constantly turning, I think, the bottom 10% of his employee base. For those strategic hires, you got individuals that might not have a seat on the bus or they might not fit what your culture is. That kind of went away over the last 2 years, I would say, because we were just trying to get bodies in seats because of retirements, other reasons why people quit working. And so what I would recommend is looking at that stuff now and not waiting until you have to do it. If you would go through and rank your team members, could you rank them all? And just doesn't mean we're getting rid of anyone now, but would you have a swatch of people that you would expect if things changed? This is where I'm going to go. You take the heart and the human nature out of it and you make it more objective versus if you're sitting down as a management group, let's just say in 6 months from now, and now we have to do it. The human nature, your heart comes into it, it makes it much tougher than if you do it while things are good and you're being more objective. So those are some of the risks. So how can we improve? And I think a lot of these things you guys are probably aware of. We've talked, at length already of what are the KPIs you're monitoring? Do you have dashboards? Do you have ways of getting information out of your accounting system, if it's an ERP down to QuickBooks, and being able to dissect it and determine what is key for you? The three that I've mentioned today already is inventory days, AR days, AP days. There's many more out there, but those are three that usually bridge everyone, and it's a good place to focus. Review your expenses. Do you prepare a budget? How often do you update your budget? Is it just an annual thing that you do at the beginning and you just put it away? Similar to a strategic plan, you just put it up on the shelf and you're proud that you did it, but you don't really use it. I think Ryan could probably talk to length about how that worked in the past and how often you guys would have updated on your end, Ryan.
Yeah, so we would do an annual plan every year, and then we'd have working forecasts. So because things change, as you print the annual plan, it's already obsolescence, right? Because things have already changed since you got it off the printer. So we'd look at it every month. Now, I'd recommend smaller companies, maybe every quarter, looking at kind of where you're at, what you're projecting. Again, this allows you to be proactive versus reactive. And again, we looked at it every month because we were publicly traded. So we had to see kind of to investors, kind of see how we were flowing from a revenue standpoint, from an expense standpoint, and from a profit standpoint. But I'd recommend at least quarterly if you can get there, or semi-annually, because again, things change along the way. Something happens, the economy changes, whatnot. So you can at least see what you're going to project out. And then as leadership and management, you can make those key decisions to be beneficial to you at the end of the year.
Thanks, Ryan. Reduce waste. Ryan's talked about it, a little bit, and I'm excited to hear more from Ryan, how he's done this in the past. But, one that we've all heard of is lean manufacturing. How do we start from one end, move all the way through the other end of the process to sell it with the least resistance? And so that's something that I just put on here. That's an easy one. I know Ryan's talked about waste analysis. There's other key things out there too, but I would say the one that everyone knows is lean manufacturing. I don't think we're there, but are we prepared to renegotiate with our suppliers? I know we've had that happen in the past. If it's a key supplier, it makes it tougher. But also on that end, if you have a supplier or a customer that's a significant portion of your overall sales or purchases, how are you prepared if they go away, 6 months from now? How are we going to reposition ourselves? How are we going to move forward? I hate to say it sounds doomsday-ish as I'm talking up here, but it's really just trying to be prepared and start talking about this so when something does happen, good or bad, you can start working through those steps and you have a cadence, I would say, as you're working through it. I think a lot of us do this already. Offer discounts for early payments. What are we willing to give? Are we willing to give a net 10 for 15-day payments? 7-day payments. I know in different industries, it's much tighter turnaround. And so what are we willing to give to get that cash flow into my pocket quicker? So if I can get 90% of my cash 7 to 10 days earlier, would it be worth 2, 3, 4, 5% of a discount to get that money in here? Accept multiple forms of payment. I think a lot of us are doing credit, ACH, checks. It'll be interesting as we go. Will businesses start to transition to other forms of payments? We've heard of crypto, we've heard of other things. I don't think we're by any means there yet. But what's our tolerance for different ways to get paid? And where do we like it? ACH is pretty quick, credit cards. But what we're seeing with credit cards is a lot of people are pushing that fee, that 3% fee to process to their customers. Are you guys doing that on your end? Are you eating that cost and building it into your budget and your plan? I don't know about any of you, but I think when you go out to dinner now, everyone tells you, I'm going to process this with a credit card. You got an additional 3% fee. Most people don't bat an eye. Now we're talking about $50 to $100 versus $1,000 invoice, but I think the culture is changing people's perspectives on this. And how are you doing that too? Because I have clients that $200, $300, $500, $1 million of credit card processing. 3% is pretty hefty to their bottom line. How are we proactive with our late payers? I always talk to our team, who's your bulldog? Who's going to sit there and put their heels in and dig in and make sure you get paid? Are you cutting off a customer once they hit a certain limit? What are your credit limits? Do you even have credit limits? Those are key pieces and tactics, because the last thing you want to do is next thing, no one's focusing on it, and you have someone with a $250,000 outstanding balance to you, and they shut their doors. Or they're going to extend you to 120 or 140 days now. That makes it tough, and now I am really acting as their bank. And the bigger the customer, you can put finance charges on, they're not going to pay them. It makes us feel good, but at the end of the day, they'll just write a check for the net amount, and what are we going to do about it? My comment is, how are we inflating their sales price or their widgets that we're charging them for it to offset some of that frustration and dealing with that compliance from our side. So I went through a lot of doomsdayer stuff here, and I hope I didn't scare people too much, but honestly, we're better prepared today than we were in 08 and 09. We've talked about this at length as a group. You know, when you look at 08, just a couple high bullet points. Those companies probably had a weaker balance sheet, they were highly leveraged with debt, and they were not prepared. Let's learn from our mistakes. I would sit here and say in 2022, much stronger balance sheets. We've gotten PPP, there's ERC, there's other credits out there that people have got, plus just the overall economy around here was very strong for the last 2 to 3 years, which means lower debt leverage at this time. And also, like I said, let's learn from our mistakes and experience from 2008. Better ability to pivot is what I would say is what I've seen. We've had clients that have been in the wood manufacturing industry. I don't think it's, I think it's public knowledge. P. Graham Dunn, for example, they do decorative art, you know, wood, different things. You guys did face masks for a while, PPE. You know, people are willing to transition. I know Pioneer Equipment did some of that for a period of time. How are we fostering that and how we shifted? How are we going to continue to do that and prepare? What could we do if something happened to our #1 customer? How could we fill some of that sales volume we lost so we don't have to cut 40% of our employee workforce? The last one's a plug. We talked about it a little bit earlier, I did. Recession readiness plan. I know at Ray, we've done one, and it's probably something we're hopefully updating with everything going on. It's basically just a guide. It might have 10 to 20 items on there of what can we pull if we need to stop the bleeding. You know, so one I know at one point we talked about is if we don't want to lose our employees and we want to keep them, do we stop some of our retirement profit sharing for a period of time to get things back? Or do we stop repaying cell phone reimbursement for a period of time? I think people would rather be employed than get a $50 reimbursement, but when you multiply that across your employee base, for us, that was significant. So what are you looking at that you could pull? Because I think at the end of the day, in all honesty, we are slow to fire and quick to hire, which is great. You know, we give people the opportunity to correct their mistakes. We want to keep them. Our goal in this community is help each other out. But with that, what else are we going to pull or stop to continue that process? So overall, that was a big piece. Like I said, it's a shorter presentation at this point. Wanted to open up to questions. I have Ryan here. You know, he has a significant amount of background. So if there's questions out there, you know, please let us know. We'd love to hear what you guys are thinking. What are you experiencing? How is your industries working right now? Are you seeing things slowing? So just like to open it up if anyone would be willing to either make a comment or ask a question. Hey, Rochelle, can you right here, Greg? It's Greg right here, Greg.
Now, I just want to congratulate you on taking this approach. I am in commercial banking, and yeah, I can tell you the industry is talking about this. The banking industry is talking about this with their customers about, you know, having a plan for a recession and what levers you're going to pull and those types of things. So kudos to you to be having those conversations with your customers.
Is it just too early this morning, or? And if you're not comfortable, or you know, I'm always under the side too of it takes me a little bit to process at times. You know, please catch us afterwards. You know, we'll have business cards available. I think there's information on the slide deck. We'll send those out also. But our goal as Ray and Associates is to be a trusted advisor to you, to sit beside you and help you through your business through the tough times. And for us to do that, we really need to hear your feedback. What are you seeing? How are you doing? What are you trying to do? You know, and our goal is to give you some maybe thoughts on that, maybe some other things we've seen. We're not trying to recreate the wheel here. It's just taking what someone does very well and trying to help implement it in other places and go back and forth. That's our community. I would say that's our belief here in this area, in these counties. And so we'd love to hear from you guys. Also, I'll make a plug. Every one of us here at Ray love tours. I think a lot of people like to give tours. Andrew and I love it. We love to see the inner workings of what you guys do, how you work, and how you make your product. My plug always is I went to Kent State, and my professors told me, you know, here's how, based on theory, it should work. Got a lot of clients that don't follow that, and if a professor probably saw it, they'd say they wouldn't be out of business. They're making a lot more money than I ever will. So I just love to see how that works for everyone.
And as much as Dustin might not like me saying it, touring a manufacturing facility is way better than touring his office. So
I don't know.
yeah. So one thing that I wanted to add was, you know, I've worked with a lot of you in the room from a cost standpoint, understanding what costs are, and really enjoyed that. And so one thing that I've seen over the past couple of years, obviously, is, and Dustin hit on it, everything's changed. And so, you know, when you're costing product, a lot of times it's from a pricing standpoint, there's inherently a lot of assumptions that have to be made and that have to be done because you just don't know. It's an estimate. And so, you know, I would really challenge people to start to challenge those assumptions and figure out this assumption, how can we actually go to straight to our P&L and our actual costs and figure out, is it still relevant or do we need to really update this? So that's one of the biggest gaps that I've seen as I've worked with folks from a cost standpoint.
And I'll just echo that. So at Smucker's just recently, so I went in the sales and marketing side. In the last year and a half, we've had so many differences on price changes on our brands and everything because of the cost dynamics. And the key is to understand all those input costs from not just like the raw material ingredients, but freight, transportation. It's all factors of the supply chain. So again, I was away from home and they didn't take price increases for multiple years. In this last year and a half, we had 5 or 6 iterations and different. Now we sell everything away from home, from consumer, pet, coffee, but we took multiple iterations throughout the year on pricing. And being in then with our customers, you got to give them 2 or 3 months in advance. It's different in your organization or your industry, but similar concepts though. Understanding that price increase in inflation costs allowed us to get to the right margins. And we looked at SKU rat. Big point he called out was SKU rationalization. What are SKUs that are profitable? What are not? The ones that aren't profitable, if you realize that, those are all line time and resources that you're dedicating time to, that you aren't getting the benefit of the return or the ROI on it. So looking at that, understanding that will allow you to make better decisions and focus on the key lines, the key products that you want to invest your time and money in your team and assets. And so just wanted to call that out.
Morning, everyone. The positive note today is that we've got so many different speakers. If you don't like one, you don't have to listen real long. The other thing I've noted so far this morning is Dustin Raber owes some Benjamins to a couple people for some really nice comments. Yeah. And Dustin, your wife has seen that picture, by the way. We made sure we made. But in all honesty, we're gonna start a little bit and introduce ourselves. We're gonna talk about our experiences a little bit, and then we're gonna open it up for questions. You know, obviously transitioning, succession, exiting a business. We can talk about 450 different ways, and there's no book to read that explains them all and how it's going to work. So what we want to do is open it up. If anybody has specific questions, if not, Brian's got a laundry list of things where it's going to make him talk for 40 minutes. So go. Kyle Stemple, I'm the current East Central Region President, so I oversee our New Philly, Millersburg, and Worcester offices. I still am a practice partner as well, so I probably spend 25-30% of time on clients and 75% of time on people. And as those of you that run organizations know, which one's a little more difficult than the other. So, you know, client service and working with clients and seeing them successful has always been my passion. So therefore, I've kept my feet in it enough to not only stay relevant, but then also that drive. So probably 75% of my clients are manufacturers, probably 15% construction, and then being in small communities like this, a hodgepodge of everything else. So that's a little bit. I've been with Ray & Associates for 20 years. Came out of college, interned with Ray, came out of college, started full time, and during my journey, I've wore a lot of different hats, and I said, we keep finding better people to turn this segment over to. So it's been really great, and we've got really great people, and we've got a lot of knowledge in this area. So please ask questions. We've got a lot of people that can help. So
I'm Brian Kemp. I work down in the Millersburg office. I've been with Ray for 17 years now, and I started out mostly in tax and have kind of branched out to lots of things outside of that, both on the tax and entity planning side, some state and local tax, as well as lots of time spent in meetings and talking on the phone with clients. The last 3 or 4 years or so have got thrown on a lot more on the transaction side of things. And I think in the next 10 or 15 years, we're going to see a lot more succession planning transitions of businesses as you look at the average age of business owners in the area or across the US. And I don't think it's a surprise. Not everyone plans to work until 80 or 85, and eventually we're all going to die. So businesses will transition eventually. So yes, so I expect to see a lot of that in the next 10 to 15 years, especially.
I'm Rich Dyer. I'm a tax partner here in the Worcester office. Been Ray 2 years. I merged my firm into Ray. I ran my own firm for 18 years here in Worcester. Prior to that, I was garnered a lot of merger and acquisition experience at a family office for a very wealthy family in the Akron area. Tons of venture capital deals. I'm his own company. My experience, I do a lot of that today. I was structure deals. There's a lot of bankers. A lot of bankers. I'm looking at them here. Deal size all over the board. I have one I'm working on now. It's going to be 150 million probably. Biggest thing I will say is, if you're not thinking about succession planning when you're 45 or so, you probably should. Even that's 20 years out, you want to have an end goal and work yourself backwards. Otherwise, you may not achieve that end. But I have an owner right now that's 48 and he's getting offers for his company he never thought he could see. And you can't say no to certain. Okay. Background experience, I started my career in Big Four public accounting for Arthur Anderson. 10 years before that was interesting. Hard to leave that one, but I really missed working with clients more than anything. Working for just one guy over and over and over again and doing the same thing got boring to me. So getting back out to it, coming here to Worcester, buying a practice, building that practice, merging with Ray. I did my own succession plan. I did my own transition planning. What's that? I started thinking about age 50, so, and then by 56 had merged. So it was definitely on the table. I needed to plan for my own exit strategy. I didn't have kids. CPA firms aren't something you train kids for sure. Other businesses maybe not the same. You have kids, you have employees, or you have outright third-party sales. You got to figure out which way you want to go. If it's inside people, or inside employees, you got to train those leaders, future leaders. So when you're ready to go, you're ready to go.
Thanks, Rich. We're going to take a couple minutes and each of us talk about some of the deals or some of the situations that we've been in. As we said, the deals can be transitioned to families, sold to outside parties. I think one of the things that I've really enjoyed working with family-owned businesses is that I've been a part of most of the transitions that I've been a part of have been transitioning the kids. So I've done, if you look at statistically, third generation, 75% failure rate. We've been able to transition 4 or 5 clients into that third generation, and they've been extremely successful. So I kind of take, those are a lot of the type of transactions that we've done. And, what I think that people, the misunderstanding is that I think people can think, number one, I can wait till the last minute because this is easy and it's going to my kids. Wrong. You can't wait till the last minute because there is no one playbook. There is no one option. And then another thing we hear is, hey, I've got 5 kids, but only 3 of them are in the business. What does that mean? I want to be fair. I want it to be equal. Ever heard anybody say that? Fair and equal don't always work. And that's why I'm saying you can't wait till the last minute. What we like to say is that if we can look at transitioning the business 3 to 5 years out, we have the ability to help make the business stronger, i.e. getting you more money in the end. Or even if it's transitioning the kids, even looking 3 to 5 years out to see what makes the most sense. We do have to take into consideration, all of the children. We do have to take that into consideration, figure out different ways to structure those so that it can be as fair and equal as you want it to be. So the family transitions probably a lot, looking at most businesses have the operating company along with the real estate company. So not only how do we transition this business to the kids, how do we also take care of mom and dad in retirement? So that's extremely important. When you look at statistics, normally last figure I saw, about 90% of someone's net worth is wrapped up in their business. So a lot of times that whole succession also is how do we get mom and dad cash for retirement? Because a lot of times they don't have this other pot of money just sitting there already ready for retirement. So a lot of times what we may do is we start with looking at the operating company, and do we start gifting some of the operating companies, start getting the kids some ownership, start getting them to take some responsibility. As most of you know that are owners versus being a non-owner, being an owner carries a little more weight. It's a little different. And I've always been excited about getting those children and getting those young adults ownership, because I think it changes their perspective at times too. So a lot of times the standard, a lot of times we'll give ownership of the operating company. Over time, we'll get to a point that we either finish selling off the remainder of the operating company once those kids have developed some cash flow to pay for it. Or we can always use the real estate as the retirement plan for the parents. So, hey, we may gift the entire operating company, and then we use the real estate and the rent to pay parents for retirement. So, like I said, you can structure that in any different way, but that's a pretty common family transition, what we see.
One other thing, as I thought through this, like what would people be interested in? I thought through what questions do we usually get from business owners. So when we talk about succession planning, transition planning, one goes with estate planning. Estate planning is not an easy thing, and it takes a long time. Usually where we start with the business owner or parents, 2 things. Number one, you oftentimes can't get both perfect income tax planning and perfect estate tax planning. Those 2 things are usually at odds. You can save on income taxes, but that may cost you an estate tax, or you can have the perfect estate tax plan, but that means you're going to pay some income taxes. So usually the things we start going through, which we say, here's a list of things that you might want to consider, and you have to pick which ones are more important. Obviously, parents have a good living. That's usually the first one. Number 2, if it's going to kids, the kids get the business without being overburdened with debt. But also the kids don't get it for free, so they're not spoiled. You don't want to pay income taxes. You don't want to pay estate tax. You want to get step up in basis of assets. You want to gift before the asset gets super appreciated in value, but you also don't want to gift it too soon to where the kids don't really have to feel like they need to work. So there's lots of goals. I don't think I've seen an estate plan yet or a transition plan that captures every single one of those perfectly. You have to choose which ones you are more meaningful to you. There may be some business owners that say, I don't need the cash. I would rather give my kids the business, but also they don't want to give it to them for free. So how do you get both of those two things in the same plan? So those are just kind of things we start with. The other thing to keep in mind too, from an estate tax planning standpoint, is that I think it's 1/1 of 26. There is a change in the estate tax lifetime exclusion. So at this point, you can exclude $23 million of assets from estate tax. So you give your kids $23 million of assets. At 1/1/26, that gets cut in half automatically. So if politicians do nothing, which is, I think, the likely situation, that estate tax exclusion gets cut in half. And at 22 million, 23 million, a lot of people don't have a problem. At half of that value, with how much land has increased in value recently, it's going to throw a lot more people into an estate taxable problem than right now. So right now is a good time to be planning for that. It gives you a 2 to 3 year runway to make any changes. So like Rich said, planning, starting the conversations. It doesn't have to be, no one expects it to happen in a 1 month period, even sometimes a year period. You want to start those conversations and make progress on your plan over a couple year time period.
The plan will constantly evolve. When you start at 20 years out, it'll change every year. That's fine.
Two other things, which I think we'll each have a different perspective on, that we get lots of questions. If I'm going to sell, what should I be doing ahead of time to maximize value? And the other thing is just, what have we seen in mergers and acquisition over the last few years? What's going on in the area? Who's buying businesses? How are they valuing them? All of those kind of questions. I don't know which. I think a question that gets asked often, what should I be doing before I sell the business? How far ahead of time should I be making changes to maximize my value, make my business attractive, if I do want to sell the business?
It talks about a handful of us from Ray went a few years ago and got our certified exit planning advisor certificates. Basically what that is training, specific training on how to exit the business, how to evaluate the deals getting done. But what I would tell you, the most important thing is, if you're looking to, this is not as important if you're looking to transition the business to family. It's extremely important if you're looking to transition the business to a third party, somebody, outside of an arm's length transaction. The idea when we say 3 to 5 years is because what we want to do is we want to come in and do a snapshot of value and look at your business. We want to be able to tell you, hey, we think your business is worth somewhere between 5 million and 12 million. And then all of a sudden you look at me and go, well, you're crazy. 5 to 12 million. How is my business somewhere between 5 and 12 million? You can't do better for me than that? Well, here's the challenge. What we've got to figure out as we look at that, we do that range of value, what we're looking at is, what are the things that we're discounting to say you're worth closer to the 5 million than the 12 million? So here's the things that, if an outsider comes in and looks at your business, that they're going to beat you up on. You're the owner and you have the only relationships with the clients. Discount. You're in one specific industry. I do nothing but aerospace. Discount. I've got an extremely weak management team that I'm allowed to do nothing. I make all the decisions. Discount. So what we do is we want to come in and say, okay, here's your weak areas. Here's where you're going to get discounted. And now over the next 2 to 3 to 5 years, how do we strengthen the business in those areas so you're closer to that $12 million fee than that $5 million fee? I think what people don't realize is, if you've got an outside buyer, more than likely, and most of the time, They don't want you around. They're coming in and buying your profits. They're coming in and buying your cash flow. A lot of times they don't want you around. So basically, they're not going to buy you, keep paying you, and then not be able to collect on a return on their investment. So that's why we talk about 3 to 5 years, looking at that far out, because it's extremely important, because it gives us time to strengthen the business. You know, if you've got venture capital, you've got something like that, what they want to see is that you've got process procedures in place. You've got a great management team. You're very diverse in what you do in industries. So when one industry's down, another is up, and the business is steady. That's what they want to see, because all they're doing is buying a return on their investment.
2 other things too that it gives you time to do. It gives you time to clean up your balance sheet. So, you know, I bought a condo in Colorado 12 years ago, 20 years ago, and it's sitting in my corporation. Well, when I sell my business, I don't want that to go with it. Get that kind of stuff out of the company, off the balance sheet, to make it cleaner, easier for an outside person to read. That's number one. Number two, especially as you get into larger deals, state and local tax nexus is a huge subject that comes up with buyers. It's an easy way for a buyer to beat down price or put holdbacks out there so they don't have to pay you so much up front. With the Wayfair ruling back in 2018-ish, somewhere in there, it significantly complicated sales tax for anyone selling outside of your home state. So that and the traveling in other states, selling in other states, having employees in other states, all of those things are going to come up in due diligence when a buyer is looking at it. And it will, if you've done nothing, they will significantly reduce selling price or put holdbacks, so that, because the reality is, if you have a sophisticated buyer coming in and you've done nothing, they're going to clean it up after the fact and make you pay for it by reducing your sales price.
Another discount that Kyle did not mention is customer concentration. I see it on both sides, on both sells and buys. If you're 50% on one customer, I guarantee you they're going to discount your acquisition price or your sale price. But there's ways to fix that, or how do you approach that with a prospective buyer? Other thing is a product. Do you have a specialty product that you only make? You have a specialty process that you only use. Patents, trademarks. If you're just an OEM manufacturer making other people's stuff, now the buyer is all on your customers. That customer can go anywhere. Long-term contracts with your customers are a good thing to have if you're trying to generate a higher valuation for your business.
Does anybody have any specific questions they want us to try to address in regards to exiting or succession planning? Yes. Because the three of us can ramble all morning.
Can you spend a couple minutes talking about employee ESOPs?
We've seen a resurgence in ESOPs in the last few years. They were popular back in the 80s, 90s timeframe, maybe a few years before I was practicing. And they seem to have made a resurgence. I don't want to say I'm the ESOP expert by any means. They work in some cases. They are one of the more expensive ways of having business ownership. You don't pay taxes if you do it correctly through an S corp, but you pay a lot of fees. Fees for audits, trustees, valuations, lots of different things. So it's a expensive way to manage a business. Right. Yeah, net of taxes. It's interesting. you see ESOPs make this resurgence. You also see ESOPs that have been around for a while looking to get out because there is a eventual large obligation to buy out employees. So you see it on the other side too. There's some local ESOPs that have sold out to fulfill that obligation. So yeah, I don't know what it is that's causing the resurgence, other than the fact that there's more business owners exiting. People, a lot of employer or business owners want to ensure their employees that they'll have a job. I mean, that they want to see the business succeed. They want their employees to stick around, and in some cases, an ESOP is a good answer. Sometimes people think ESOP is the only answer to keep their employees around, and that's not necessarily the case either.
I'm sitting here trying as he's talking that to see how I can politically correct, really speak my mind on ESOPs. I think that for about 1 out of every 10 ESOPs I see, I think makes sense. I think there's some groups out there pushing ESOPs way too hard. They're way too expensive to run. Like I said, 1 out of 10 I've seen, I think makes sense. I think one of the reasons you're seeing that is because we've got a lot, we've grown some of these businesses in these communities to a significant amount of size and profitability. And you can't, if somebody's qualified off the street to even run it, I can't go into a bank like I could have 25 years ago and them give me a loan to buy this business.
Or one key employee.
Yeah, or one key employee go buy the business. They don't have, and these people don't have the net wealth to get those loans. So I think that's a big player in it. I think the other player in it is a lot of people that have the money to buy those businesses is venture capital, strategic buyers. They don't care about the people. The strategic buyers very rarely care about the people. They care about the return on their investment. So what ends up happening, they come in and buy, they need their return on investment. And to a business owner, I think when I work with my clients, my family-owned clients, that business is their family. It's their family name. It's we all want to leave something and want to be remembered for something. So I think some of these business owners have a hard time. If I go and sell my business to venture capital, my family name's gone. They're going to fire some of my employees. And I think as a family business, we're passionate about our people. So I think that's probably the second biggest, I think, and by doing that ESOP, we're saying, hey, you people, you can own this business. The problem, we strap them with a lot of problems. The other challenge is if you don't have an extremely strong management team, an ESOP will never work. The other thing is you may have a strong management team today, but if you're not an organization that continually reinvests in your people to develop the leaders of tomorrow, you're going to fail too. So some of these businesses go to ESOPs and they may have a really strong management team today, but 5 years from now, some of those people retire and they didn't develop in the ESOP bus.
Hey, Kyle, can I add one thing?
Yeah.
One thing I'm seeing too is with an ESOP, business owners become secondary. So you have a bank coming in and you have to suffice that bank debt first. And so one recommendation I always look at is if you have a strong management team, and I'm, as a business owner, going to have to finance a portion anyways, why not look at my key management and see if they just be willing to buy it and I'm finance it from the start. I save my ESOP expenses and use that to pay down the debt of the financee, which is your owners. And so that's one thing I think doesn't always get looked at is if you do have a strong management team, what's their appetite? Would they be willing to partner with the owners? You still can get your legacy. You can still have the owners get their funds they need, and you save that cost in the long run.
Dustin was the one we originally wanted to speak on this answer that. He deals with a lot of them.
And private equity gets a bad name in terms of like firing employees. And I mean, rightly so in some circumstances, there's no doubt. Private equity selection is key if you're looking to sell to private equity because there's a huge variety out there. And I think you have a lot more experience in that.
Most private equity companies don't buy to hold, they buy to flip. Usually a 3 to 5 year period of time is what private equity looks. 25 to 45% annualized. Other thing to think about is if you're going out to third parties, there's usually two types of buyers out there. There's the financial buyer, which is not going to give you the best value for your business, or the strategic buyer. That will give you much higher valuations. I'm seeing valuations today in deals anywhere from a low of 5 right now to 12 or more, depending on the type of buyer.
And what do you, yeah.
So multi would be a multiplier EBITDA. So if it's a financial buyers, I'm seeing are more on the lower end, 4 to 6. But I have one deal now where we're working with a strategic acquirer that's probably going to be a 15 to 18 times EBITDA number. But they think they can take a $20 million EBITDA business and make it a $50 million EBITDA business in 3 years. They're going to pay that number.
So Rich, maybe expand on earlier, you guys talked about what you can do in the 3 to 5 years leading up to an acquisition. Maybe just a couple points. What has that business done well to set them up to get such a high multiple?
Make a lot of money. This particular company has gone from 7 million in sales to 33 million in sales in the last 4 years. An EBITDA number of say 2 million to this year, they should hit 14 to 15 million. Employee base has gone from 26 to about 130. Specific industry, it's a pipeline laying industry. There's not a lot out there, but their contracts with large companies, they're 5-year contracts. I mean, we're probably 3 customers, 70% of the revenue, 5-year contracts with those customers. They're set up forever. And the industry they're in, anytime you're working like a Dominion East Ohio as an example, their pipelines, they're set out 45 years in advance. Money's already appropriate. 45 years of work. They just pick and choose whatever job they want, whatever gives them the best market. Other questions?
So if you have a product line or a product that you would like to spin off or sell off, how do you prepare for that looking ahead, like you're talking on transition to prepare that for market? And make sure that you can get your maximum value.
Are there specific patents or trademarks on the product?
Actually, I'm just looking into the future as I'm speaking of Dustin's conversation of the bottom.
If you have something that you're developing and you can patent that, by far I would go that route. Find a patent attorney and go that route. And then I would most likely spin that out into a separate entity. So it's away from your other business.
Yeah.
And then try to market it that way.
Yeah, being able to track that business unit or whatever it is that you're trying to sell as its own separate entity, even separating into an LLC that's owned by whatever business you have, some sort of legal separation, being able to track it separately from an accounting standpoint so you can see and prove to a buyer, here's what the financial performance looks like. Having it perform as its own separate unit as well, having employees dedicated to it and being able to track their time, all of those things will set it up so that it's easier to peel out of your normal, or whatever you're trying to keep, peel it out and sell it off to a buyer. All of those things, and again, if you're looking at wanting to have specific performance for that, even before you peel it out into a separate entity, you may want to start tracking that separately from an accounting standpoint. So you have the history, and if, so an outside buyer can do evaluation on that, and they've got 3 or 5 years of history to see how that unit has performed.
I will say when we're advising clients on transition, merger and acquisition, spin outs or anything, that our job is to try to make your company more valuable, not less complex, for sure. Always make it more complex.
Yeah, because you could have every single thing you do in its own separate LLC and have accounting for everything, but you'll need a team of accountants to do it, and they tend to not be cheaper employees. So you're right. You want to have the appropriate amount of complexity without being overly complex.
And yes, he just did talk out of both sides of his mouth.
One other thing too, just from a past experience, having a couple of things, having a team around you that's made up of your accountant and largely your attorney. We are lucky to have good attorneys in this area that have experience in M&A, and that is huge, because a lot of times, especially with private equity or public companies that are buyers, they are using accountants and attorneys that are not small local offices, and you need to have someone who knows what to look for. I forget if it was you and I talking about it. Some of the attorneys we work with say, they come in, think that they're gonna, just bull rush some local yokel attorney, and they either use boilerplate stuff that just doesn't get changed, or they try to flip things into agreements that is more favorable for the buyer, let's just say. And so having a good attorney that's knowledgeable in that, having an accountant that can help with due diligence, that can help with net working capital calculations, that can help with state and local tax preparation, so you know what to say and what to do before you meet up with that due diligence. Those are all key things to have as well.
Just to add to a comment Brian's talking about, I think this is one of the biggest disservices that as professionals that we continue to fight, is that I remember the old days, you'd go in, meet with the client, they would have their banker, their attorney, their accountant there, and really dig in so everybody knew all the businesses surrounding that. So I think it's extremely important. Same thing when we're preparing to sell or we're preparing to do something. You've got to get your advisors in a room together. Your bankers need to be there. Your attorneys need to be there. Any one of your advisors. Sometimes your investment folks need to be in that room, because no matter how that deal's structured, it's going to impact different pieces that you have those specialists for. So make sure that everybody's in the room. And that's not just selling a business or acquiring a business. That's just as a business as a whole. I mean, at least once a year, you should be meeting as a group with everybody, making sure everybody's on the same page in that. Unfortunately, sometimes we find out too late something has happened, and now, we call it post-mortem tax planning, or we have to try to reverse something that was done because the attorney didn't talk to the accountant or accountant attorney, whatever that is. So make sure your advisors are all in the room. Greg, you owe me $20, by the way.
Good questions.
I guess my question is, how would you start a conversation about a merger or acquisition with a potential supplier or customer or competitor without opening your books completely up and telling them things that might be things you don't want them to know if it doesn't happen?
So if you have a company you're interested in selling, and you think, well, my competitors are likely acquire it, of course they are. Having conversations with them are good. Non-disclosure agreements are necessary before you touch anything financial or operational. A lot of times we'll go out and very boilerplate stuff with, a lot of times they'll use us as the guy. Hey, here's a 2-pager on Joe Schmo Company. Don't mention any company names, and we send them to your competitors for you. We act as your representative. They don't know who it is. And we get them to sign NDAs and then provide indication of interest or letters of intent to buy the business. And then we let them know who you are. So, but it's easy to do if you're using your professional advisors as your middleman.
You know, those NDAs are important, the letter of intent, what's in that, you know, you do have, I've got one going on right now that it's one of their competitors, and you know, the competitors want us to open the books and stuff, and they want to start talking to all the people, and I'm like, whoa, back up here. I said, you know, who are the key people you really want to talk to? Well, really just the CEO and the CFO. I said, okay, well, your letter of intent says you basically want to talk to every employee in the company. You know, so you have to be cognizant of what type of people you're dealing with. You know, this is another family-owned company. They really care about their employees like we do. And we've stressed to them all along that we're only at the table with you because we want a family-owned company to own this company. So we're putting trust in you that you view your company like we view ours. I can go to a public company tomorrow and sell it for double if I wanted to, but that's not what the owner wants. So there is a trust factor, and there is, you know, my owner, he gets a little uncomfortable with things, and I got to talk him off the ledge, and I got to ask him to not talk sometimes when we're in those meetings, because sometimes what he'll say, we don't want him to say. But I really think just that you do have to have some trust when it gets down to it.
And yeah, what you don't want to do is show up with, here's my top 10 customers and here's my profit and look at how great of a business we built. And yeah.
So a lot of times what ends up happening is that we'll show those gross profit reports. We'll show the top 10 customers, but it's customer 1, 2, 3, 4, 5. So we just start redacting. It's real information, but we've redacted who the customer is or who our supplier is and stuff like that to help protect. And if they're strategic and in our industry, they're going to look at our margins compared to they're going to try to compare apples to apples and stuff. But so there's ways you can get stuff to keep as much proprietary, confidential as we can. So.
All right, I think, one more, and then we'll hit the break.
I'm a QuickBooks Pro advisor. I get called into a lot of I just have to say first, don't wait. You know, I talked to a guy 2 weeks earlier and never know what you're the plan just changed. I would say that you're just that same one. The first question I asked. That's all they did. And I called Ray in, Ray did an extra study, and they found they owed $140,000. They're ready to sell. So I'm just saying, don't wait and don't just because no, there's no way to get out of jail on this.
And that's a good point. We talked about, you know, here's what to do 3 to 5 years. In reality, those are best practices to do regardless of whether you're selling. It's not like you should just wait to do those things until you're ready to sell in 5 years. I mean, yeah, those are all things that you should be doing regardless of whether you're going to sell or not.
All right, so we are right on schedule. I don't know if there's any more questions, but if you have a question for these guys, be sure to catch them later throughout the day or jot down their contact info and reach out to them or anybody from Ray. We'll get you in touch with them. So right now, next session, our speaker is going to be Rex Moskovitz. He's a senior manager in our Ray Information Services Group, and he's got over 30 years of experience from a cybersecurity information services standpoint. So let's be sure to give Rex our attention.
Yep, all set.
Okay.
Thank you, everybody. I really appreciate you taking the time out of your busy day to come here and be with us. Again, thank you, Andrew, for leading this effort. So good to see everybody. I'm very glad you're here. Very, very important to us in the community and the firm. As Andrew said, my name is Rex Moskovitz. I lead the governance, risk, and compliance segment for the firm. My role is to work with each of you and your teams, your companies, your constituents to make cybersecurity, information technology, ERP, enterprise resource planning integration as simple as possible. I'm going to summarize cybersecurity, which can be a very, very nebulous topic, as succinctly as I possibly can. Your data, your processes, your intellectual capital is secrets that are the essence of your business, which you will pass on to your generations, is vitally important to somebody else. So cybersecurity is the principles, the practices, the techniques of making sure that those somebody else's do not get access to the essence of what your generational knowledge and wealth is. So let's talk about that a little bit. And the purpose of the conversation today is to talk to you a little bit about some basic information with respect to cybersecurity. I'm going to talk about 10 questions that I'd like you to walk away with, to think about on a daily basis, to really identify in and amongst yourselves and with your teams, with your constituents, if you really are and you really have a safe and secure environment. We're going to talk about a real life case study that I was directly involved in. And then finally, I'll end today's conversation with how me and my team can help you if you need us. So again, cybersecurity is not new. It's been around since effectively the late 70s, when data and technology started to emerge out of its infancy into becoming what's known today as the new oil. Everything is about data, and data is about everything. It takes on many types and different forms. It's structured, unstructured. It's more than just social security numbers or credit cards, where people live, how many employees you have, what type of relationships that you have in the business, in the marketplace. It's about accounts, bank accounts, retirement accounts, pension accounts. It's about your business processes, the intellectual capital that has real value. It's about who and what you deal with on a daily basis, who your clients are, and more importantly, who your competitors are and what your competitors want to know about you. It's not simple hackers anymore. It's about sophisticated bad actors that operate on a global basis. Your businesses and everything that you value could be compromised by somebody as far away as Indonesia, and in ways that you would never have even thought possible before. There's more computing power in this laptop today than there was on the first Apollo mission to put a lunar module on the moon. And that power and that access to that power is available to anybody. So What I want you to take away today is the three aspects of cybersecurity that are the bedrock of any platform, any process, any system that you'll have to protect what's important to you. It's called the CIA triad. So again, if I leave you with nothing else today, I want you to remember CIA, which is confidentiality, integrity, and availability. Fundamentally, all cybersecurity protective systems and processes are rooted back to, is your data and what you identify as confidential and important to you. Do you even know what that is? How is that data classified? What's the availability of that data and who has access to that data? And is that availability protected? And integrity. How accurate is that data? How up to date is that data? Is it current, correct, and complete? Is it current, correct, and complete? It's the CIA triad. Let's talk a little bit about some basic elements of information security. Those elements are some things we come to know on a daily basis. Physical access. No different than putting a lock on your door, putting your garage door down. If your garage door is up, making sure that the door that leads from the kitchen or the laundry room to the garage is locked. Are the windows closed? In the realm that I deal with, if you have a server room, is that server room locked? Do you have a visitor's log? Who do you actually know who's coming in and out of your business? What are the access and entry points and egress points of your business? Do you know who's coming in there? Where do they have access within your building? Some organizations take it very, very seriously. For a long time, I had United Technologies as a client, and I dealt exclusively with their aerospace and defense division. The access controls in those plants was unbelievable. And the guards that monitor those access controls, not only to get into the building, but once you were into the building, how to actually get to your workspace, was all governed by, like on a freeway, specific lines. And those guards had guns. And if you veered outside of that designated walkway, they would give you one warning. That was it. Now, I'm sure those controls aren't as rigid in your businesses, but nevertheless, want to be embedded in your mind in terms of how important knowing who comes in your business and who leaves your business and where they have been and what they have seen, what they've had access to, is vitally important. There are procedural controls, policies and procedures. How many times have amongst yourselves thought, okay, all this is going to do is just sit on a bookshelf somewhere. No one's really going to look at it. Right up to the point when it's too late and there's an incident that requires a response. And then everyone is scrambling around trying to figure out, well, what do we do? Who do we call? Where do we even begin? How do we start? How do we know it's stopped? Those procedural controls are vitally important. They are vitally important. Technical controls. A fire alarm, a key code access, badge to get into the door. These are the essential elements that everyone, every business, regrettably has to have now to stay secure for a myriad of reasons. Cybersecurity just being one part of it. Compliance controls. If you're in the healthcare business, you have a HIPAA violation, you know how significant of a problem that can be. financial institutions, banking, pensions, other finance organizations. The controls in place that have to be followed are very strict and very stringent. And across all of those, education, healthcare, finance, there's Graham-Leach-Bliley Act, for which a report has to be completed and submitted every year to the board of directors and the executive committee that identifies specifically what are the controls that are in place, how many cybersecurity events occurred, what the information technology architecture is like, what's the identification and the risk and controls matrix between of general controls, key controls, how inherent risk is then mitigated to a residual risk rating. The understanding of all of that, vital for business, and it's absolutely necessary for statutory compliance. Sarbanes-Oxley. If you're involved in any type of Sarbanes-Oxley, recently, within the last 24 months, Sarbanes-Oxley has been updated to include information technology controls for non-financial reporting data. Okay. Very, very important. Data is everywhere. It's not just on the computer. It's not just on the servers. And on-premises computing very soon will be completely overtaken by cloud operations. That everything you do, all the data you process, will be in a data center someplace else. Could be in India, could be in Malaysia, could be in the Philippines, could be in the United States, could be in Canada, could be in Latin America. It's vital to have an understanding of the environment that you're keeping your data in, the classification of that data, and knowing where and how that data is being used and who has access to it at all times. All of this is the ecosystem of cybersecurity and information technology controls, what used to be called reverently as ITGCs, internal controls, IT general controls, okay? It's just now been expanded somewhat exponentially with the cloud. So keeping CIA in mind, confidentiality, data integrity, data availability, let's talk through 10 questions that I want to introduce you to that I'd like you to keep in mind and think about as you go forward and continue your businesses in this very, very oftentimes dangerous external environment that we all live in. What's important to each of you? Think about all the data and all the relationships, all the clients, all the vendors, all the bank accounts, the financial information, pension information, tax reporting, internal management, accounting reporting. Think about what actually is very, very important to you, what's critical to you. For some, it may be the intellectual capital. We have some clients that their intellectual capital is absolutely everything. And they have adopted controls and security architecture structures so no one person in the entire organization can have complete access to all the intellectual capital, meaning designs, drawings, formulas at any one time. What information and systems are most important for you to protect? For some clients, it's their book of business. It's their clients list. It's their distribution network. For some, it may be their partners, who they actually do business with, and who they have to be involved with on a daily basis to produce a product or service that goes out the door. It may be the contract information. It may be the people and the skills and knowledge and attributes those people bring to bear every day that make you and your business unique in the marketplace. How are those systems maintained? One of the biggest problems that we see, that I see every single day, is systems that have gone without proper security patch updates. So one of the benefits and one of the marketing principles that companies like Microsoft, Amazon Web Services, that they provide is when you're in the cloud, you no longer have to worry about patch updates because they're provided automatically. But if you have a server, if all your processes are embedded within your physical structure, okay, it's vitally important to make sure that you keep those patch and security updates current. It used to be you could go a month, maybe a quarter, and worry about it, but now there's patch updates at least once a week and sometimes 2 or 3 times a week because the environment is changing so much. Because the threats that are out there, there are several organizations, the Massachusetts Institute of Technology for one, that has what are called common vulnerability events, CVEs. Has anybody ever heard of those? CVEs are the recorded events by a non-governmental, what's called a federally funded research and development organization like MIT, that captures agnostically across the board all the different ransomware, cybersecurity, malware that exists in the world. And it's what the large companies, Microsoft, Amazon Web Services, Google, or Google Web Services, what they use and what they are integrated with to make sure that their security patches are updated with the most complete responses so that they help their clients avoid incidents before they begin. Is your data complete and accurate? This never really comes into play a whole lot, except when you're thinking about or you're migrating from an old system to a new system, from an outdated platform or application to a new one. Going from Excel spreadsheets to QuickBooks. Going from QuickBooks to, let's say, NetSuite. Going from NetSuite to full-on Oracle or SAP or Great Plains or Acumatica, any other type of large enterprise resource planning system, where it's vitally important to make sure that the data that's being extracted from the source system going to the target system is correct. When was the last time that you actually asked the question, has anybody gone through and done a validation of our data sets? Should we purge data? Do we have information and old employees or old clients that are in there that we really don't need anymore? Data is expensive. Data is very expensive. Years ago, I had an accounting professor tell me, and I never forgot this. He said, Rex, data is expensive. If you don't need it, then get rid of it because you're paying for something then that you don't need. It's like aged inventory. When was the last time that you actually thought about that? How much data are you actually carrying? Is that data archived? What's your archival strategy? Meaning, how am I getting information that I want to keep, but it is not relevant or necessary to my existing operations, and I don't want to keep it and maintain it in a database and then keep having to buy tape backups every single time, and I can't do something, or I can't run a patch update, or I can't change a business process because I don't have enough memory in my database structures because I've got 17 years of data that's sitting in my existing production database. What controls need to be added, changed, or deleted? Has anybody heard the term CRUD? C-R-U-D. CRUD stands for create, release, update, or delete. CRUD applies not just to data, but also the controls. How current are my controls? If I have a more sophisticated system, do I need more sophisticated controls? Maybe. If I'm going from Excel to QuickBooks, well, I'm going from a manual control to an automated control. So when was the last time that I looked back and I thought about, okay, I'm in a new system, I'm in a new platform, I've got new automation. Have my controls changed? Have I communicated those controls to my auditors? Are my auditors aware of that? How is the data protected through the life cycle? Data and systems, everything seems to run through what's called a life cycle maturity model, an LCM. Just like I talked about, what's your archival strategy? How many years of data are you retaining? If you're going to go from an old platform to a new platform, do I really need to pay to have 5 years of data migrated over? A lot of systems integrators, they won't even do it because the risk is too high for them in terms of the data acquisition, validation, cleansing, and revalidation. The general rule is to have 1 year of data migrate over. If you need 2 for every year, every month thereafter of additional data, the costs go really up as the risk profile on the project goes up as well. So think about, what's the life cycle of the data that I have? Again, why? Because data is expensive and it costs you money. How available is the data that you currently have? The really important stuff that you need to make decisions. Can you get access to it immediately? Do you have to call somebody to get it? Does a special report need to be developed to get to that data? What is it that you really, really need fundamentally to run your business and make sound business decisions every day? Do I want a current operating expense? Can I make a capital investment decision? Over what period of time? What's my gross margin? What's my net margin? What's my available inventory on hand? What's the inventory that I need to replenish if a certain amount of stock goes to a certain level or below a certain level? How many customers do I need at what particular sales rate and margin to break even? What's my payroll going to be this month? What's it going to be in 6 months? What's my tax impact? Should I buy this business or not? Should I use capital or should I pay it in cash? Do you have the information that you really, really need from your systems and your data to make those critical business decisions when you want it, the way you want it? How often do you back up? Do you back up daily, monthly, quarterly? I've never backed up a system. What's the answer to that? It's something you have to ask yourself. And we talked about security patches already. Again, these are the types of questions that would challenge you and I want you to think about on a recurring basis. How you answer these questions is a key indicator in terms of how secure your technological, your data, your cybersecurity infrastructure and architecture really, really is. So let's talk a little bit about a case study. One misnomer that I get a lot and I want to put to bed immediately is, well, we're not that big. Really don't have a risk. That only happens to the big guys. It happens to everybody. Again, your data, your processes, your intellectual capital are vitally, vitally important to somebody else. What we have seen in the community for the past year and a half is accelerated phishing activity. Sending emails that look very, very legitimate. Open this PDF file. It's an invoice. It's something from the bank. The moment you click on that link, you've just executed a virus or a piece of malware or what's called an embedded script that gets into your system, and it can wreak havoc now. It can be timed to wreak havoc in 6 months, a year and a half, 2 years, whatever the bad actor wants to do. We've seen a lot of activity, tremendous activity in terms of notifications to customers. Please send the invoice and payment for this invoice to this new routing number. The bank account has changed. We've seen a lot of that in the local community. But it happens to big accounts too. We have a very large bank client, and they have spent millions on security architecture. They can talk for hours on the CIA triad. There's just one problem to all the things and all the stopgaps that they've put into place, is that they didn't have effective monitoring controls. And when an event occurred, talk about that a little bit here. When an event occurred, their patching wasn't up to date. This is a large, large bank. It's a $2 billion bank with a lot of integrated systems, and nobody was monitoring it. Nobody checked to make sure that their security patching on their banking systems was up to date. They had an employee, a contractor, that had left, and as far as as part of the outboarding process, the exit process, the HR department didn't go ahead and shut down or put in the paperwork to shut down the user ID and the password. It was an open window right there. There was no change control process, and as a result, there was no monitoring. So even though the automated systems were saying that something was wrong, we're seeing a lot of different and unique internet activity through what's called the IP address, the Internet Protocol address. Nobody monitored the screens. And for a period of 25 days, 25 days, nobody knew what was going on until somebody, an analyst, came in one morning and said, you know, we are being able to see where somebody had access through this former employee, former contractor's user ID and website to install screen share. The screen share was on the CEO's laptop, the CFO's laptop, the CIO's laptop, and the head of HR. So they could see exactly all the email communication that the CEO was sending about business activities. They could see the financial reporting before the CFO, it's a public company, before there was a formal release of the data. They could see and identify how many employees were active and what type of access those employees had to all the bank systems. They were unable to rapidly gather and identify, based upon the telemetry, based upon the data profile and the activity through this IP address, specifically where the data was being taken, if there was an exfiltration of data, how bad any exfiltration of data was, or if it was just an event and someone was watching. So we were called in to help them with that incident response and do that data analysis. Fortunately, we did not identify any data being pulled out or exfiltration of data. We've been monitoring them consistently now for the past 6 months just to make sure, because there was a screen share program that was inserted. That screen share program was not open someplace else. But we were also able to identify, most importantly, if anyone here is from a financial institution, okay, the financial software that runs the bank and the account information for clients, that's kept on a separate server with a separate set of applications called Fiserv applications. All that was accessed was the bank's internal communications network and internal organizational structure. So we were able to help identify that. We had to issue a formal report. Any National Association bank in the country, any National Association financial institution is governed by the Office of the Comptroller of the Currency. So we had to do all the legwork and help them put together the information necessary to respond and report to the Office of the Comptroller of the Currency so that the bank wouldn't be shut down. It was a very significant cyber event. But the key message here that I want to convey is, even though this is a very large organization, it was a sophisticated attack, it came down to one essential element. One essential element is that a former employee's user ID and password were not shut down. And that is a malady that affects all of us. You don't have to be a $2 billion business to have that event occur with you. These are the questions, these are the things to think about, how we can help you. Like I said, I run the governance, risk, and compliance solution for the firm. We work with clients every single day to help them. What are their governance structures? What's an appropriate technological architecture for them? If you have an incident, how we can help you, how we can do the data analysis, how we can parse through the structured and unstructured data to identify if indeed there's a problem. Is it a security event? Is it a teenager that's just playing around, they got access and doesn't know what they're doing? How long a bad actor has been or is in your system? How long? We help set up policies and procedures. We help you with statutory reporting in terms of what type of compliance and what type of reporting that you are required to provide if indeed there's an event, and what to do before an event. Do you need cybersecurity insurance? A lot of companies will not provide coverage unless you can identify and prove that the things we've talked about today, that the elements of the CIA triad, confidentiality, integrity, and availability are met, and that you have standing, recurring, repeatable controls in place prior to going ahead and releasing the binder and underwriting a policy. Is your cybersecurity coverage appropriate for your business and your needs? Does your policy cover the right things at the right time, if and when you need it? These are some of the things that we can help with. Are you involved in a government or a DoD supply chain contract? We can help you with that. We can help you get to a level 1 certification that enables you to continue to do business in the DoD federal government supply chain system. IT general controls reviews. We do financial audit support. We do all the technology auditing for our attest clients. Third-party risk assessments, SOC audits. This is what we do and how we help you and your businesses in the community on a broader scale. So with that being said, I thank you for your time. I hope this was helpful and informative to you. I hope I've given you some things to think about and to continue to think about. And most importantly, again, if there's only one thing that I impart upon you today, is that you remember CIA. Because CIA, confidentiality, integrity, availability, is the fundamental of how all your business processes and your technology architecture and the controls, internal and external, are built from that CIA triad. So thank you very much for your time and attention. If there's any questions I can answer, I'm more than happy to do that.
All right, so I think we're going to go ahead and kick off the last session here before lunch. So I may have slipped them a few bucks to keep it short so we can get on with lunch, but lunch will be here at 11:30. So before we get started, just want to introduce Colin Neidert and Andrew James from 2020 Ventures and 2020 Analytics. So I'll let them introduce themselves when they get up here, but they bring a wide range of experience from a change management, technology, transformation, data analytics standpoint. So I'll let them take it from here.
It takes 39 milliseconds to make a first impression. So I know that before I even said anything, you guys have already formed an opinion. And I thought to myself, if it only takes 39 milliseconds to make a first impression, why does it take so long to change? Personally, with an organization, as we think about new technology, emerging technologies, embracing change is just something that humans struggle with. Ray and Associates asked us to be here to talk about some of those things as it relates to digital transformation. I'm honored, humbled to be here. My name's Colin. I'm going to talk through a few of the lessons that we've learned as we help clients navigate change, especially as it relates to technology. And then Andrew's going to give you some examples of analytics and how we use that. So I know it's a little bit of a mixed audience. I'm hoping to distill some things into we'll call it 5 lessons, but I think throughout there's more than that. The first thing that what I would like to talk about is point number 1, as we think about change, especially as it relates to implementing new systems. How many in here, quickly, show of hands, how many of you have actually implemented a new system, are thinking about implementing new systems, or have any type of organizational change? So it's impacted quite a few of us. This is the number one thing that we talk with clients about. You're not actually changing technology, you're changing mindset. Because on the other side of that technology are people and users, and is ultimately what matters. So this is not an exercise in new systems. We can talk about robotic process automation, we can talk about AI, we can talk about ERP systems, but at the end of the day, this comes down to people. Transformation is a big word, and I looked it up. It means to change completely in form or in nature. And I was thinking, well, why as organizations do we have to change? Why do we have to transform completely? And I don't know about you, the last 3 years have been, everybody uses the word unprecedented, right? Global wars, we're in a recession, we're not in a recession, I'm not sure. Depends on what news headline you read. Inflation. And then as manufacturers, many of you in here, where did all the workers go? We deal with more manufacturers today that say, we can't find folks that actually want to do a hard day's worth of manual labor. And on top of that, now we got to show them computer screens. We got to get them used to technology that they don't even want a part of. How do we navigate all that change, and why is it important? One thing that we see is we know that the next 10 years, you have to change the way that you're operating in order to be successful. What worked 30 years ago, what worked 10 years ago, what worked 5 years ago is no longer going to work in the future. Not when you have big technology and big companies, quite honestly, hacking the minds of the youth that are coming into the workforce. Their algorithms are spot on, and the folks that are out there are used to information at the click of a button, right at their fingertips at all times. And so as we look at businesses and we work with businesses, businesses are asking the same thing. How do I get a pulse on what's happening around me? But all of it starts with bad data in, bad data out. And so focusing on our users and the people that need to change and the people need to embrace change is a big piece of this. So when we talk about transformation, the one thing we always talk through is the change curve. And this may be a 3-week cycle, this may be a 3-year cycle, but we encounter this all the time, where initially the reaction is, okay, we're changing systems, or we're changing leadership, or we're changing the way that we're doing things, or we have a new strategy where we're going to sell our products online, we're going to go direct to the consumer. Whatever that change might be, inevitably, there's always this curve. And the valley of despair is typically where it goes off the rails. So the valley of despair is, we put the change in place, we've been talking about it for a while, and now it's here and it's upon us. And when it inevitably happens, is you get chaos, a little bit of chaos, right? Hopefully you can control some of that chaos, but people do not like change. So what we hear a lot is, I wish this system could do what the old system did. I don't understand what this is telling me. Where do I get this report? I don't understand why so-and-so can't follow their processes. Why can this team do what they're supposed to do, but this team can't? I wish that we could go back to the way things were. And if you don't navigate from a leadership standpoint your way out of that valley of despair, this is where it crashes and burns. We've seen organizations take years. I mean years to implement systems. But if they don't recognize that they're actually implementing a change in culture and a change in mindset, it takes even longer. So remember, when you come out and say with excitement, hey, we're upgrading systems, this is what your employees think. Oh my gosh, we're doing what? I don't even like cats, but I like that cat. So rule number 1, this is about changing mindset and changing mindset of your employees. Number 2, one thing that really helps with changing mindset, clarity. It is more about communication and messaging than you think. So while we have technical folks on our team that can help navigate everything from a overhaul of your accounting processes to implementing new systems, fundamentally, if there's not clarity in what we're doing and why we're doing it, then it's much more difficult to change mindset. Here's a quick tool that we use. It's very simple. It's what? The main point of what I'm trying to get across. This is the big idea. This is what we're doing. This is why we have to do it. The so what, why it's important, why it matters to you as an individual, and also to us as an organization to be successful. And then finally, the now what. Here's what's next. And these are the tactical plans. Here's what you're going to see. Here are the things that are going to happen over the next 3 weeks, the next 3 months, the next 3 years. If you can remember what, so what, now what, and use it not only in communication broadly to your organization, but in emails, when you're running a meeting, being able to articulate with clarity, this is why it matters, and having the context around that is critical. If you don't contextualize why it's important, then people don't understand the urgency behind what you're trying to roll out. And as business owners, you have that bird's eye view of the business. You know what's coming. Your employees do not. So why would I have to change if it's been working all along? You're sitting there from that 50,000-foot view saying, I know what's coming, and if we don't change, we're dead. Number 3, this is one we encourage clients to do before they get into an ERP implementation. Take a hard look at your current state culture. Are they actually ready for change? So if we know it's about changing mindset and we know it's about providing clarity, where do I sit currently today? And when I say take a look at your business, I mean take a hard look. Because if you implement systems and new processes and do it effectively, this will challenge leadership. This will challenge your strategy. This will challenge existing ways of how you do business. The roles that people are sitting in, the decisions and how you make those decisions, all of those things you should start asking yourself right now. And I think it's okay and actually very healthy to say, you know what, on this level, we're only a level 2. Our processes, we don't even have any of them documented. I can't tell you how many times we see technology implemented and the end user said, well, this doesn't even apply to what I do. You don't even know my process. It's okay to take a hard look and say, this is where we're starting from. Here are some decisions that we may have to make along the way. Here are some things that we're going to have to consider. But if you don't take that hard look in the window or in the mirror and say, this is what our organization is really all about, and are we actually ready to sustain change and bring change into effect, then rule number 4 is going to hit you, and it's going to hit you hard. Technology will spotlight your hard decisions. What do you do when the information says that your 20-year operator can't hit metrics, that your throughput metrics on your machine are X, and they consistently fall short? You're going to rely on those metrics? Are you going to fire that 20-year employee? How do you want to make decisions with technology? Because if you have a real-time view of your business, and your business says, these folks over here are having a problem, what do you do if they've been with you for 30 years? We've run into that. Being prepared up front on how we want to manage our culture, the people around us that support our businesses every day. You just have to be eyes wide open. What are the decisions that we're willing to make and what are the ones we're not? And sometimes this spotlights hard decisions that you've neglected for a long time. This leader that I've had in place, who I'm not quite sure is in the right seat, it'll be exposed when there's real-time visibility. This is probably not good for a room of accountants. One thing just to keep in mind, accounting is almost always the easiest thing to automate. And I'm not saying that accountants, we don't want to get rid of accountants, but we do want to get rid of the manual processes related to accounting. And here's why, because most businesses need a financial advisor in the business. And more often than not, the people who have truly a pulse on the bottom line are so busy sifting through data, trying to make it make sense, that they're not bringing strategic perspective. McKinsey did a study, this is part of the reason I left Fortune 500 accounting, to be honest, is that when robots come and when automation comes, lawyers and accountants are the first to go. Just a fact. AI can study law 24 hours a day. Going back to the change curve, anticipate the journey. So we talked about, this is about changing mindset. We do that with clarity. We know that we have to take a hard assessment of our current state culture. Are we ready for this? And hard decisions are going to come up. So begin to anticipate the journey. The first step of that is leadership buy-in. So often organizations silo IT and say, well, this is an IT project. When you're implementing new systems, this is a company-wide initiative. And if your folks have not bought in at the leadership level and don't understand what it's going to mean for their individual departments and areas, you're in trouble. I would also say this should be about saving time, saving money, and saving headache. Just because it's a new technology does not mean you should implement it. I see organizations that run very effectively on spreadsheets and QuickBooks. I see other ones that bring in the latest ERP system and they're a mess. So it comes down to the culture that you've actually instilled in your organization. And are your folks process driven? Are they willing to change? Are they willing to embrace new things? And then finally, number 5. And honestly, number 5 is kind of like there's like 10 things in here. But 5 sounded better than 10. There's no such thing as a flawless implementation. It just doesn't exist. I see some smiles, I see some smirks. Some folks hire us and they'll say, we're bringing you on so that this thing can be just perfect. And there's no such thing. It doesn't exist. There's always going to be a point where you didn't anticipate what was coming next. There was a scenario you didn't account for. Be eyes wide open about the fact that this will not go perfectly. Don't try to do everything. I don't know why ERP systems put so many buttons on my screen. Why are there so many buttons? Why are there so many things that I could potentially choose from? And it leaves you in a state of paralysis. Should we do this? Should we do that? We had a client that did 2 years of discovery work before they rolled out one small business unit. And even then, they're not sure they got it right. Stay with the simple. If you start with something simple, you can always build on top of it. Okay, you can always add that enhanced feature. You can always do that thing, but it's about the core, the fundamentals, getting those things right first, and don't try to do everything. For manufacturers especially, shop floor screens should be simple. Like, insanely simple. There's no reason to have extra buttons. There's no reason to have extra filters. If there are 2 or 3 things that we need them to do, that should all be the only thing on the screen. And I would encourage the same thing for all your users. Make sure that their screens apply to them. If you really want to get buy-in in a system, we preach this all the time. If it didn't happen in the system, it didn't happen. You get a lot of organizational chatter when people are like, well, this so-and-so did this over here, and so-and-so, I don't see it in my system. Why don't they put it in the system? Because you know, as a business owner, there's a ton of time, money invested into this system. So if you're going to rely on it, you got to actually have folks relying on it. The more you can preach this, especially if you're rolling out a new system, hey, if it didn't happen in the system, I don't want to talk about it because you're not following process. And then finally, vulnerability almost always wins. It's okay from the start to say, hey, here's what we're anticipating. Here's what we're doing. Here's why it matters. Here's the plan of attack, but we're not superhuman. We cannot predict the future. And because of that, some of this may not go as planned. But that's honestly part of the change curve. If you lean into that, if you say, we're going to have points in this journey that are difficult, and some of you may not like me, and some of you may not like each other, but at the end of the day, we're going to get through this because our culture is strong enough to do so. Then you're starting to set up the organization for success. I'm going to be on the panel in a little bit as well, have plenty of time for questions. I want to give Andrew time to walk through some real life examples of analytics and what he's doing. I would encourage you, get out your phone. We like to guide business owners into what's possible. Do a little QR code scan. If you fill out just that simple information, that'll come directly to me. I'm happy to have a conversation about what's next for you and your organization. But with nothing further, I will turn it over to Andrew.
Thank you, Colin. Ultimately, Colin makes my life easy because he just sets me up for everything. I do apologize I don't have any funny cats in my presentation, but I will try to make this as exciting as possible before we go to lunch. I do need to ask from a Ray perspective. Last time I had to present after lunch, so everybody was sleeping. This time I have to present right before lunch, so everybody's hangry. So how do I get like a primo, like time slot to actually be able to do my presentation? So as Colin introduced me here, make sure this works. Like it might be dead already, but my name is Andrew James. I spent the first 12 years of my career at the James Smucker Company in various accounting and manufacturing roles. So I started out as just a financial analyst at a milk plant, and then I actually became a controller at a different milk plant and ran the logistics and planning department. After I kind of got back to corporate, they said, hey, why don't you go run an accounts payable department? If anybody runs accounts payable, I am sorry, that was the hardest job I've ever had in my life. So we had about $7 billion that went through that department at 25 employees, 2,000 users. Never again will I ever run an accounts payable department of that. So I sympathize with any of you guys out there. From there, I went and I was a regional controller at Land O'Lakes. So I oversaw all their butter and powder plants. I did that for a couple of years. And then Colin suckered me into going to an e-commerce company as a CFO, and we did that for a while. He bought me so many dinners to talk me into it, and he eventually convinced me. So from there, then Colin and I started 2020 Ventures and 2020 Analytics. So we've been doing that for the last couple of years. And it's been an awesome experience because we get to come do things like this and actually every single day work on something that we're very passionate about. So it's been awesome. So what we do as a 2020 Ventures and from a 2020 Analytics perspective is we really have 4 key functions. As Colin hit on, we have the advisory services and the change management, because nothing we do on the analytics works unless you get that buy-in and everything that Colin just discussed. We also have an investment side of our business, of our portfolio. So we will actually invest in companies and buy companies as well. So if you guys know of any companies for sale, we're always open to talk about that. And lastly, as we've gotten into more of the analytics space, as we've gotten into that change management, so much of marketing is super important nowadays. So if you think about all your Facebook ads, your Google ads, just getting marketing out in front of people, that's changed so much that we also decided to bring in some marketing into our company as well.
Go on the front end and see it and course correct.
So really diverse. Today, we're really focusing on more of the advisory services and change management, as Colin hit on, and then I'm going to dig in a little bit more on the BI side. Before we dig in too much, who here is using anything like Power BI, Tableau, Domo, any other visual tools? Got a couple of people here. Anybody want to talk about how that process has went so far? Great. Awesome. Flawless implementation? Yes. Maybe 1 in a trillion will be a flawless implementation. But some of the systems that we've worked with just over our careers, we spent our first 12 years working in Oracle and things like that. Since then, we've been able to branch out in Epicor, N4, AWS, the whole 365 suite, Azure, all that kind of stuff. So we are using a lot of different systems. And as we go into a client, one of the best things about it is if you actually look behind the scenes in any of these systems, everything's the same information. You always are going to have customers out there. You're always going to have invoices out there. You're always going to have payroll out there, et cetera. It's just how do you get that data? So we can walk in pretty quickly and say, here's the things that we need, point us in that direction, and then we can actually start pulling that information and getting you the reporting that you need. So I just like to always bring that up because someone will be like, oh, you don't have maybe Dynamics up there. Yeah, but I'll be able to get into Dynamics within a week and get information out of it and start to be able to build something. So just a good way to kind of simplify things. Colin alluded to this a little bit in his presentation. When I worked at Smucker's, when I worked at Land O'Lakes, and even my wife, who still works for Fortune 500, her whole life right now is checking numbers. So if someone runs a report out of the system, they put it into a nice Excel spreadsheet, then they put it into a great, pretty PowerPoint because that's what somebody wants. And then all of a sudden, by the time that's done, then you're doing the same thing the next month. When do you actually have time to help the business? When do you have time to go meet with your business partners and say, hey, our margin's decreasing? Or, hey, we're paying too much in overtime. What's going on? Why do we have inefficiencies out of our plan? So much of our time anymore is just that reporting aspect. And as accountants, we really don't necessarily want to do all that reporting. We'd rather be in those business meetings. We'd rather be out there on the floor helping people get better. So what this is saying is how analytics is going to help people is from 3% of our time, actually being able to help the floor. We want to get to that 69, 70% of the time. We're always going to have time where we're booking journal entries or doing things at our desk, but we want to start to drive the business. And ultimately, that's the evolution of accounting and finance that analytics is going to help to bring. Colin and I created this kind of what we call the different pillars of analytics. So kind of working from left to right. A lot of times people will start with data visualization. So you might go and stand up a Power BI, you might go and stand up a Spotfire. And then as you do that, you're like, this can't be right. You get some crazy number out there. You might have $1 billion transaction, or you have a bunch of customers without names in it or addresses or information. So that really shine a light on your data integrity. And what we've seen a lot of companies do is they'll go from the visualization aspect to realize, oh my gosh, I got a lot of work to do in my ERP because none of the information is correct. We had one client that I built something, that's one of the Ray clients, showed them a bunch of the information from their ERP. And I said, we need a new ERP system. This isn't tracking anything that we actually want from a behind the scenes perspective. So what we kind of see is a lot of people say, oh yeah, we're ready to go. Let's do this data visualization. Let's get insights. And the data behind the scenes is such a mess that you don't get insights day one. The only insights that you're really getting are we need to go scrub our data. We really need to clean this up. And we need to do a better process of capturing maybe certain fields or changing how we do stuff. With that, once you start to understand where you have some of those gaps, that's when the data processes come into effect. So do we need a new ERP system? Do we need a new field? Do we need a new way of just doing this? One of the clients that Colin alluded to a little bit, every time we'd ask them a question as we were implementing the ERP, they said, it depends. It depends, and a data process is not a good answer. You can't have 30 different if statements to say, well, if it's this and this and this, you need a simplified process. I think the computer might have died. Data analytics don't work if it's not plugged in, by the way. So gotta have some power. You're good. Yeah, so sometimes because of it, that'll also you have this clear test. Once all this happens, right, you get your that's when this is got a New York database. Lastly, and this is the most thing as we think about data analytics. Data analytics are great. I bet your gut and feel and the business work for you. Great. But sometimes a lot of those times, those insights from the data is going to tell you something, and you've wasted. That's Smuckers. We I get from everybody. It's whoever, and you'll still have someone say, "My gut tells me." Are you spending 30 on data? So as business, as accountants, as people,
Acquisitions.
I like to do a hybrid of the two. Gut and feel. There's some people that are just like, so our typical that is going back to the last. Anybody that's done business with, it's usually we take a 2-week introduction We just meet with a bunch of people. Some systems are truly so locked down that it's hard. Always goes through that. So from the perspective, somebody will start. We want to counting. Nice is as you kind of get a and other groups. Hey, I have this process. I like that. A little bit of matter for that just taking time. So usually start with that smallest. Then build something quickly. You know, it's not going to be 100%. Nothing is that. Don't build something to get. They can start seeing what the tool from liking the. That's when all this back comes. Usually when I meet with a client and I say, hey, how can we do meeting like for once I then put something out of this, hey, here's something. Ideas will come 100 miles per hour right into their head. They're like, whoa, let us start small and we'll skip it out after that. But that's why we get that build in front of the client's hands. And then lastly, we're going to now you have, say, 25 users. Ideas come in, reiterate after 5 years old. And that also helps everybody. So that's usually kind of our 4 steps to actually put something into being. So why analytics, right? Why spend money, time and effort? A lot of times what we see is you will go into an organization, has to do the same. Every week I go and run a sales report, download it into a pivot table, mail it to 20 people. How boring is that? I can't do that for the rest of my life. Only for 35 years I have to download sales reports, nothing to do. So by doing some of these things, now the person that's taking that download is actually studying the report. They're understanding why am I up in sales? Why am I down year over? They can start understanding that where now that email is insightful, say, hey, sales are up because price actually went up. Sold 30 more units. As somebody that cares about their job, that cares about, they want to do that versus staying all the time down there. Some organizations will go a little bit more of a harder stance. They'll actually reduce that. Something that we do and sell to everybody because we know how hard it is. But some companies will actually reduce headcount or redeploy that headcount to work. As Colin talked about in this recession, non-recession, it's hard to hire people. But if you can free up some bodies before that already know your organization, you know the people, that's a huge home run versus having to hire somebody. My favorite thing on this whole slide is provide greater insights. We had a client that's up in Cleveland, they're about $350 million. And their CFO, their CEO. So as we were building out something for them, we got in his hands first. He started pinging salespeople within 10 minutes. He started pinging the CFO within 10 minutes. What's going on here? What's going on there? And
into these other.
So it completely changed the whole mindset just because that CEO started firing off email. So the same line to this customer. So it was just crazy how quickly that those insights do. Right now, they started looking at. They wanted the technology. They wanted the analytics, and they wanted to start coming up with those answers before the CEO started. But no one wants to be in that situation where the CEO is asking.
This is anything that's
How many people have went to the meeting, everybody's brought their own spreadsheet and none of them have timed each other? That was the story of my life quite a bit. So one of the other things that comes out of this is one source. By getting the data set combined, by getting it where everybody's combing through it, they're saying, yep, I'm giving that the thumbs up. That is now a repeatable process that gives you the thumbs up. It's not marketing has a different number than sales, that has a different number than accounting. You now have one source of truth that you're all looking at, and you're not wasting that whole hour trying to figure out which spreadsheet's right. Because I hate if I accidentally didn't copy down my formula and it's looking. I don't want to be in that situation. Take 45 minutes. And then lastly, a couple of other things. Obviously, we talked about laying the culture of analytics. Change management has to start at that higher level. If your CEOs, your CFOs, your directors, your operations guys, girls, whoever, if they are not buying into analytics, no one underneath them will. We have one client that we've been trying to get analytics. Their CEO is all about it. COO is not about it. The CFO is not about it. People underneath them aren't about it. So we have been pushing and pushing to get all those people bought in until finally the CEO started doing that. Started asking for more money. Started bringing it into meetings, pulling up the dashboard himself, asking questions. So you have to start it at that higher level now so that everybody. So who thinks data analytics is just a scary term in general, has no idea what it is? I'm still terrified of it this day, so I'll keep my hand up, but it's scary. But ultimately, when you hear things as a database, just think of that as an Excel spreadsheet. Rows in it, you have columns in it, stores information, you can access it, and you can pull it down to third. Nothing scary about it, no different than an SQL, right? Another scary term that you hear. I remember the first time I got to corporate Smuckers and IT sitting there pounding their keyboards with select statements and all this other stuff. All it is a formula. No different than you put an equal sign in an Excel box and adding two different columns together or two different rows. Same exact thing. And Power BI, right? It's like PowerPoint. You can create graphs in it, you can create text boxes in it, you add values into it, create all the pretty pictures that you want, just with a lot more horsepower. We try to use Power BI as much as possible when we do out data visualization clients. A couple reasons why is Microsoft's always investing. Microsoft obviously is a company. They have tons of money to invest behind it. A lot of people naturally have Microsoft products. They have 365, you have Excel, you have Outlook, SharePoint, etc. Power BI works great with all those. So sometimes we won't need that crazy SQL database out there. We can go make your Excel spreadsheet. Last thing, who has ever heard of Power Automate? So Power Automate is like hiring a computer to do repetitive tasks. So I remember when I was in that glorious accounts payable role, we spent a month to be able to get an email invoice saved into it. We had our customers, they would email us the invoice, or our vendors email us the invoice, but save it down, and then we'd have someone actually do it. It took us forever to get that process set up. And Power Automate, within 5 minutes, I could have that happen. Instead of opening old mail, scanning it into the system, having copies of it, then 5 minutes, we can have Power Automate. Every time an email comes in, it's saved. We actually just set up something for Ray themselves, where they email me a report, my email automatically takes it out, refreshes the Power BI. Within 10 minutes, that report is now in Power BI. So Power Automate can do tons of different repetitive tasks. That's just something small that we've used it for lately. But pretty much anything a human can do, if it's click and point and fill in boxes, all that stuff, Power Automate can do all that. Before I jump into some of the demos here, any questions or any stories maybe someone wants to share about data visualization or data analytics and how it's helped their organization?
I got one. How do you work with your clients on, thank you. How do you work with your clients on managing their executives' biases towards data? Because when they maybe have preconceived notions of how their business is supposed to, the direction they're supposed to go, and now they have one data point that tells them maybe that they were right all along. How do you kind of balance that with being more conservative and looking at trends? What's your approach?
I think that's probably the worst thing is back to the team. One of the things that we do is obviously you don't want to confront someone and say, no, this number's the absolute number. So we have that opened up. Obviously, or two. And we work. I'm going to shut down.
So Andrew mentioned a project here with Ray. Talk a little bit about, to do a Power BI, do you have to link directly into the system, or can you get data out into a spreadsheet and then into Power BI? What are all the different ways to do that?
Yeah, so ultimately from a Power BI perspective, they have about 1,000 different connectors. We can do everything from your Excels and your CSVs. I've actually brought in PDFs and pulled data directly off PDFs to do reporting because a client had a bunch of invoices that were only captured in PDF form. You can connect directly into ERPs, into databases. So really there's over 1,000 different ways that we can connect to data and pull it in. Not everything has to be exactly from your ERP or a nice SQL database or something like that. Do you guys want to talk about a little bit about how you guys deployed Power BI?
Yeah, so we're pulling data out from a workflow management standpoint. And as Andrew mentioned, set processes up to basically refresh that data every day. So it's probably at this point, maybe 5 minutes of one of our folks' time to kick off a report. Emails get sent automatically, the reports get updated automatically, and then we have basically real-time data on our workflows and how things are moving through our processes and our systems. So it's been a pretty big win. I think we're still early, and like Andrew said, we kind of, I don't want to say just threw something together, but we kind of did, and now we're making tweaks and figuring out what we want to see, what else we want to see, maybe what we built a couple weeks ago and isn't really relevant. So it's been good, and it's been really nice to not have to go out and have 5 different people run Excel reports or run reports, dump them in Excel, throw a bunch of filters, and take 30 minutes a piece to get to the same results. So
yeah. And within that 5 minutes, we're running it for all of their offices versus just each office running it their own individual way. Now everybody has a global picture and all looking at the same data. And I know as we kind of went on early with it, there were times where we said that data is not right. And so then we knew that we actually had to do some cleanup in the system as well to get the data right.
I'm going to say we've been using Power BI now for about 4.5 to 5 years, and we probably have 15 or 20 reports built. It's probably one of the most powerful tools you can have. Anyone that thinks they can do it with dashboards is, no, they can't. I mean, we can literally click on almost anything and have instantaneous results. We suck the data out of Epicore's cube at night, so we're within 10 to 12 hours of real time. You never want to try to be real time with it.
Yep.
I can see sales as of last night. I can see I was just checking the log inventory, the hardwood limb inventory. I mean, it is so powerful.
Yep.
So it's a great, we couldn't have done without it.
If you want to do the rest of my presentation, that's going to be a lot better than I can present up here.
I can actually put up real live stuff. Yeah.
And I think that's also a good point if you think about it too. So as you start to load more and more data into it, now you have all the historicals. So if I want to take 2022 data and compare it against 2019 data, I can do a couple slices and now I have that comparison. Or if I want to compare it against 21, there's so much more dynamic that you can do versus a stale PowerPoint or a stale Excel spreadsheet that you just naturally get that benefit and you can start to see more and more trends and things like that. We created, it's kind of going to be a modified version of the first dashboard I show you here. But everybody within the organization wanted to see something different. So if you were the CEO, he might have wanted to see net profit, right? And then if you're somebody in accounting, maybe you wanted to see your net income level. So we actually created the dashboards with drop downs where across the top, you could select what you wanted to see and it pulled in all those metrics for you. So now every user could customize the dashboards themselves by using drop downs and have the picture that mattered to them. And then it saved it out there. So every time they open, they got those same metrics. So there's just a lot of cool flexibility that you can do within Power BI. So I'm going to walk you through kind of two demos. One's a little bit more detailed than the other, but these are two real demos that we've actually shared out to clients. The first one is the client that we had that was in Cleveland that I told you the CEO started bombarding his team with as soon as we released this. They wanted to take every single item in their P&L and allocate it to SKU and customer. Anybody else ever done that? I'd say it is a heck of a time to do it. I will tell you that. So I think Colin and I, it took us what, 6-7 months, something like that, to be able to do it. It was about, I think whenever you had all the data sets fully blown out before we consolidated everything, it was probably like 30 to 40 million rows with allocations in it. And so what we did is we truly took every single P&L line item, came up with how we wanted to allocate it if it wasn't directly allocatable, and we actually gave them those measures to be able to say, for this customer, this item, here's how much profitability I'm making. So I'm going to show that one first. And then the second one here is just a high level P&L. So pull the P&L every single night, refreshes in the dashboard. You get some of those details that you can drill into as well. I'm going to try to hurry here because I know we're getting close to lunch. So this is kind of a mock-up of that original dashboard that we did. There we go. So this is a mock-up of that original dashboard that we created for them. And when I talk about some of the dynamics and the flexibility that we have, as you can kind of see up here in this top left-hand corner, you have all of your years. So you can go back 4 years, go back 5 years, however long you guys want to look at your data or interpret it. You also have the flexibility in here to do anything by month, just with a quick click. And then you can also flip between month to date and year to date. So everything is just dynamic. Whatever the end user wants to look at, if I want to look at year to date, year over year trends, if I want to look at year to date versus budget, if I want to start to compare month to date, any of that type of stuff I can look at. Then here's where some of the slicers start to come in. Now you can look at it by your business unit, you can look at it by your sales regions, and look at it all the way down to the product SKU. So it does give you all the flexibility that you need to be able to dive into anything. The other thing about Power BI is everything is dynamic whenever you click it. So right now I just clicked on this beverage graph here. Everything else in this dashboard will now update to just look at beverage. So pretty quickly you can start to jump through your different sets of data and understand maybe where you have variances, where you have issues, where you have concerns. I can also jump in if I want to look at by a region. I can click the region and now I'm just looking at that Midwest. So once you get this stuff stood up, it's so easy because now every night it's just refreshing. You're coming in the morning, your data is all there, you can start to look at it. If you think about it from people that are heavy into PowerPoint or heavy into Excel spreadsheets, I have to go get all this data, I have to put it into my Excel spreadsheet, I have to refresh a pivot table or drag some formulas down, and then I have to email it versus just coming in and the data being right there for me to start to look at.
And then you can create different tabs in here, just like you can in Excel. So that one was kind of like an overview, like a high level view. This one is more product specific. You can start to see your P&Ls. You can start to see which sales channels are generating your revenue, and then start to see kind of what items you're selling, and then what your profit is for each one of those. And now you can start to get into more of a region where you're clicking on different regions and different states where your sales are happening.
Task within a manufacturing
To show net profit and net sales and things like that. So super powerful tool. And then this one was a lot more basic. Ultimately, what the company wanted is something to replace their actual PowerPoints on a monthly basis. So this is what we go through now with them for their close process. So just a simple P&L. This is kind of what their categories are that they wanted in here. And then within Power BI, you can also do dynamic commentary. So if you think about, like in this case, total sales changed by 9.5 million, that automatically updates in there. So I don't have to go type in, like in PowerPoint, 9.5 million, put it in. All that type of commentary we can dynamically update within the system, where then you can start to say net sales went up by 9.5 million, and we can actually write logic to tell you why it went up by 9.5 million. So makes life a whole lot easier than trying to dig through some of that information and then put it into a PowerPoint. What we also did for this client is, so this was the kind of the high level splash of the total company view. Behind it, then we started breaking it out into each one of their business units. So on their campus, they had 4 different business units. We actually created P&Ls for each one of those, where then they could see what their labor was versus absorption. They could see what their manufacturing variances were, what their throughputs were, and it created a financial scorecard for each one of their business units underneath it. So kind of gave them a little bit more flexibility than what they had done previously. And once again, everything's dynamic in here. If I wanted to flip over to a balance sheet, I can flip over to a balance sheet. I have my balance sheet. If I want to flip back to a P&L, I can flip back to the P&L instead of running multiple reports or trial balances and flipping back and forth through them. I think I'm going to show one more real quick. I can find where my PowerPoint went. So this is the one that I like for anybody in manufacturing. One of the things that Colin talked about was making sure that screens were easy to use. Come on. Oh my gosh, come on. Sorry. PowerPoint crashed on me there. Does anybody want to see the cat again? Throw that up there. Open hyperlink, let's do that. So the gentleman over here said that he used Epicor. We actually created, in our Epicor cube, we're actually exporting data every 10 minutes out of Epicor and loading it into tables. So within 10 minutes of you reporting something in the system, this dashboard here, one like this dashboard here, will ultimately refresh. So what we did is out on every single manufacturing line on the floor, they have a TV with this dashboard up. So as the associate is reporting production, as they're issuing material, all this is updating within 10 minutes for them. So they know exactly on the job how much they produce, how much they still need to produce. Are they hitting certain throughput metrics? One of the things that they have is they should never have 2 of these IDs on a job open at a time. So we created a bar graph and it'll show if they have multiples of those out there. So instead of going into the system and clicking through 10 different screens to look at your labor, to look at your materials, to look at your job quantities, it is all now right there refreshing every 10 minutes right in front of them. What's great about this is behind the scenes, we're taking all this data, aggregating it for every line, every business unit, and the supervisor have a snapshot of their 10 different lines, exactly how it's running at that point in time, how much longer that line should be running, and if they see issues, then they can go talk to the associate and know what's going on. So this is probably of all the dashboards that we've created, one of my favorites, because when I was in manufacturing, I wish I had this much insights every 5 to 10 minutes versus waiting a couple days, or for me, when I was at Smucker's month end, run a bunch of reports and slam it all together and realize that I have an issue somewhere. But yeah, so we created this and it's been a huge hit. We've kind of went through some modifications of it. We have a simpler one that ultimately just tells them what they have remaining and then where they're off from their throughput goal. And so some people like that better. Some people like more of the detail depending on the line, but all the data is the same and we can just drag and drop things and switch it depending on what the end user wants. So. But I will let everybody start to get to lunch here. Any last questions, any ideas, anything anybody wants to talk about from a data perspective?
I think we're ready. We got 5 to 10 minutes.
Okay. A little bit of everything, honestly. I'd say Epicor is the one that we spent the last year using the most, Epicor and N4. So those are probably the ones that are most recent, but I've integrated with a bunch of different things. Yep. Yep, SAP, or we use a lot of Oracle back at Smucker's. So what's nice about SAP is it's pretty rigid. So data has to be done a certain way and there it has to be pretty clean and everything else. So, but. And then we've even done actually setting up the whole data warehouse aspect of it and that type of stuff, not just kind of the front end reporting. So, yeah.
You just get the data from them. Like, so if they have an upgrade in Oracle and databases or tables change, does it affect you at all in BI or?
It depends on what happens behind the scenes. So if new tables are ultimately created, we'd have to go back in and update those tables and actually create them. Sometimes new fields will come in, so we will have to modify reports to pull in those new fields. It kind of just depends on what type of upgrade it is. A lot of your cloud stuff, from what we've seen, doesn't have major changes where 90% of the data is still there, and it might just be a couple extra columns that then we have to go and add in after the fact. So kind of depends on what kind of upgrade. But one of the good things when we start talking about upgrades or changing ERP systems, where this can help is as you start to load your master data, as you start to cut over certain aspects of it, you can use these type of tools to understand where you have gaps in your current data that you need to fix so you can start with the new clean information in your ERP system. Anything you want to add to that? Colin's hangry. He's just ready to eat at this time. Yep. Yep. So either based on QuickBooks on-prem or QuickBooks Online. QuickBooks Online can be a little tricky from time to time, but we have pulled both QuickBooks on-prem and QuickBooks Online as well. Pull the information out of it. And even if, to Colin's point, if you're using Excel, things like that, we can connect directly to Excel and pull that. And that's where Power Automate really comes in, because whatever you're dumping to Excel, we can have Power Automate go automatically dump that to Excel. Power BI then refreshes with that information and you never have to touch it. So, because they can actually like move your mouse, click, log in, run the report, wait, dump it, like anything that we can do, we can train Power Automate to do.
Andrew, I think it was you or Colin, somebody mentioned you'd like to train your clients to make their own reports.
Yep.
So what kind of people do you like to train? What kind of skill sets do they need to be able to do, make their own visualizations and things?
So one thing I will say about this, like any type of knowledge that you gain, if you're not using it on a regular basis, you will forget it and get rusty. So usually what we try to do is more of like your analyst level or someone that's pretty good at Excel, because they'll buy into this pretty quickly and they'll start to use it on a regular basis, where then they won't get rusty over time. As far as being this type of view, this is where we'd go into your CEO, your CFO, your director of manufacturing, whoever that is. We showed them more of this type of view and how to navigate it and how to use it, sort, select, etc. And then that kind of next level down, the analyst level, etc. We'd actually teach them how to do this, how to update it, how to make sums in here, and things like that. And we
add to that.
Yeah.
We typically start with, if you can do this in Excel, I mean, anybody who's on Microsoft 365 already has the ability to download Power BI for free to their desktop, right? A lot of people don't know that. But what we'll do with folks, especially analysts, is if this is how you're doing a pivot table in Excel, let's just pull that Excel document into BI and show you how to do the exact same transformation, but behind the scenes in BI. And that's a really nice way to get folks integrated and feeling comfortable with the tool. Because once they feel comfortable, they realize this isn't as scary as I thought it was. So just getting over that initial hump of, hey, I've never done BI. I don't even know what it is. I don't even know what I'm looking at. We can draw some conclusions that here's how you do it in Excel. Here's how you can do it in BI today.
I'm sorry. Business intelligence. Sorry, one thing I was just going to add to what Colin said. We do have, actually, as part of our clients, we have what we call 101, a 201, and a 301 training that they do. So we can either lead it ourselves. We have videos on it, but it actually gives you data sets and walks you through. Here's how to bring in an Excel file. Here's how to create a pivot table. Here's how to join two data sets together. So we do already have all that training created that then we can take clients through as well.
So we do something similar. I mean, we have a USB thumb drive computer and a monitor out on the floor, and we're doing some production stuff like this. We actually don't like it because when that computer crashes, someone has to start it. So we were looking at I was at a trade show and came across a German company called Peakboard, which basically, again, can integrate with a lot of stuff. I mean, our data, we use JobBoss, but it's just all SQL data. So we wanted something, how do you roll that out to the floor so that, again, someone doesn't have to go turn it on or pull up the report or whatever that case may be.
We've had a lot of iterations on that. Have Josh on our teams back there who's handled a lot of that. The last thing that we did is we had the exact same thing. Internet goes down, it crashes, right? Or for whatever reason, we use Fire TVs out on the floor as well. We actually have that's doing it. So we actually found an automation program that every 10 minutes will kill the app and reload it. And that automation program runs like flawlessly. It's almost like Power Automate for Android. And that's what we do. So every 10 minutes, it just automatically restarts it. So if worse comes to worse, it crashes within 10 minutes, it'll pop it back up and refresh it. But yeah, we ran into some of those same issues out there and had to come up with a workaround so Josh wasn't going out every at least once a day. They had a lot of their warehouse was really big, so they just have blind spots of internet issues. So there are certain areas that would go down at least 3 times a day, and so we put our heads together and came up with that automation tool to be able to do it. Yep. Anything else? Thank you guys so much for having Colin and I today. We love to come and talk about this and show some of the work that we've been able to do. And you'll have our contact information. So if you want to reach out, please feel free to do it.
Thank you. All right. Thank you, guys.
Too many people take their lunch and bolt, so that's a good sign. Got one session left in the day. Enterprise Resource Planning Panel. So we put together these 4 individuals here. You've heard a lot of terms today like real-time data, being proactive versus reactive, automation. Okay, where do I sign? This sounds great. And then you also hear terms like change management, maybe what's the cost, how much time and energy and resources is this going to take for my organization to do this? Start backpedaling a little bit, maybe thinking through a few more things. So put together a couple questions here, but this is supposed to be informal. Feel free to raise your hand, ask questions at any time. If there's no questions, I'll continue to ask from this list that I already have pre-populated. But let's first start off, each of you just introduce yourselves, what company you're from, and maybe why are you up here? Are you currently going through an implementation, maybe one in your past role? So just basic introductions first.
Jim Smucker, I'm president at Time down in Holmes County, Charm. I am here because we had a failed ERP installation. I think that's why you invited me. I call it a successful failure. So we'll talk more about that.
I'm Cheryl Koblenz. I'm the director of accounting services here at Ray. I've been here at Ray for over 10 years, but I also spent 10 years in manufacturing, did 2 ERP implementations, and then when I came back to Ray, I kept getting pulled into those. So I think that's why I'm here, because I just can't seem to get away from them.
Colin Neidert, 2020 Ventures. This is kind of what we do. And I think that's why I'm here. We're currently in the midst of a 500 employee implementation. So we've seen everything from that to we got 10 people signed up for now. So just all sides of the spectrum, and happy to be here.
Mike Swartzentruber,
controller for Pioneer Corp, Pioneer Equipment, as most of you know them. We're going through an implementation currently. Have about 25 users, so I think that's why I'm here today. Glad to be here.
Great. Okay, so let's kick it off. First question. How do I know when it's the right time to switch ERP systems or maybe upgrade or implement a more robust ERP system? What made you guys want to make the switch? Why did you decide, okay, it's time for me to upgrade, it's time? And from Cheryl and Colin, what have you guys seen companies, reasons that they're wanting to switch? When's the right time? How do I make that decision?
Well, I can speak for Kime. We're on a system that the company told us they would not support any longer after several years. The system we were on was their main system for a number of years, and then they purchased another system, and then they decided they were going to move ahead with that. That, as well as there was a lot of capabilities that we would like to have that we did not have with this system. So in a sense, to modernize a bit our information.
So my initial reaction to this question was, you'll know if it's time. But if we go back to this morning, and Dustin talked about inventory management and cash flow management, if you do not have the data or the reports available to you out of your system to make management decisions, then you need to be evaluating your system on whether you're using it correctly, or maybe it's time to look at a new system. The other thing that I'll throw in here is it's a whole lot easier to justify a decision if your users are currently experiencing a little bit of pain. If they love your current system, you're going to have a much harder time convincing them that it's time to change. So there should be a little bit of pain where they're aggravated at the current system.
I think to add to that, I mean, I'm a finance guy by trade. To me, it's all about ROI. So how am I going to save time, save money, save headache from the system? And if I know the cost of the system and the potential cost of saving from either manual transactions or being able to make decisions faster, that's something that you should consider, because these are big investments, sometimes multi-million-dollar investments, not to mention quantifying all the hours of the folks that are going to be involved with the implementation. There's a lot of cost in this. So just like you would evaluate, should we buy this new piece of equipment? Should we go into this phase of the market? Do the same thing with your ERP and say, what's the end result of this? And does the cost justify the end result?
I second what Colin says with a extra twist to it. Maybe for us, it was a little hard to put a number to some of the time savings. Maybe it was more from the industry we were trying to penetrate, or a new industry or new processes we were trying to get to but couldn't with our current system, from a reporting end, from a data management end, and just bumping against capability. That was probably one of her biggest challenges.
Great. I would say sometimes we get the question of people want a magic number. Like, if I'm this big in revenue, or if this is the size of my company, is it time for me to switch? And you didn't hear that from any of these people up here. So thank you guys. Great answers. Okay, next, how did you guys decide which system you want to implement? And then for Cheryl and Colin, how do you guys help people decide what's the right system for them?
We brought in a consultant that helped us work through it. It took us probably a year kind of process for us. A lot of this happened before I came to Kime. I pretty much made the decision a couple months I was there, which one we were going to go with. So it was just looking at the total scope of what was out there, narrowed it down to 3, narrowed it down to 2, and then narrowed it down to 1.
I would say, kind of step back, document what your needs are. Figure out where are your pain points, and also make sure that you're asking all of your users. Yes, management and leadership needs to be involved, but also the people that are doing the data input. What are their needs? What would they be looking for that they don't have today? And make sure you have those documented. And then I do recommend bringing in a consultant to help look at the systems. If you try to go out and do all of the demos of the possible softwares that are out there, you're never going to make a decision. So bring in a consultant that can look at your business model, that maybe knows your industry and says, okay, these are maybe the top 5 that is prevalent in your industry. And then look at your business requirements. What is that need of list, that list of needs that you have? And make sure your consultant has that, but really use that consultant to to help weed out the.
I want to piggyback on what you said. We did some of that, but we are now doing a lot more of that. A lot more documentation, a lot more flow charting. We'll be a much better client this time around than we were the first time. And so really support that and feel a lot more confident that with that documentation, both you and the vendors know this is exactly what we want. And we probably did not do that as well as what we should have.
I was just talking with a lady a second ago. To me, like, I'm kind of agnostic to which ERP system to use. I think a lot of them check the same boxes, and you're getting sales order on one side, you're getting fulfillment on the other side. But we have a lot of companies that will come to us and say, I really want to build this myself. And we certainly have developers that can do that. I almost always try to steer folks away from that. Now, I will say I have not seen a tool in the market yet that is simple enough for everyone to understand. And so if you are interested in building that, I have this brainchild of mine that says we need to go build a simpler ERP system and solution, because candidly, there's just too many bells and whistles out there that prevent you from actually, again, hitting your core business needs. So I would echo what's been said here. You know when you know, and I think which system should I choose? A lot of that's based on your current state processes and the folks that you have in place to actually be able to support your implementation. One thing that's super critical, if you have a really strong internal IT person who also understands your business, make sure that you rely on them and understand how they can be part of the equation.
And Colin, do you and your team help people with selection then?
We typically come in from honestly, we're taking over one right now where we're actually inheriting an implementation.
Okay.
That's been a little tricky because some of what we would have liked and needs and wants and understanding process, we're building it as we go. But yes, absolutely. Part of the equation for us is how do we at least frame in the decisions that you're about to make? And then when it comes down to selection, it's more about what's the end result. And if we know our systems and we know our processes, and that's well documented and understood, then I think to the points that were made here, whatever you choose, you're going to have more success in doing so.
For us, the implementation took about 10 to 12 months I was leading the project internally, from what Colin said, coming from an IT history, but in a finance position. I personally had a lot of intel on all the different parts of the business. I'd say that's extremely critical as you do your research, being able to document all those processes. If you can give your potential vendor a piece of paper and they can give you a demo off of that is what we found was extremely helpful to help us weed out our vendors. We could give them a piece of paper, show me how your system does this for all your processes. It doesn't take long to decide who your vendor will be. We actually tracked our time internally just out of curiosity, how much time we spend during the complete research, just the research stage. We spent 366 hours from internal team members until we said, yes, this is the system we need. Now we're in the implementation stage. But some people say that's overkill, and it might have been. But when we started, we found the same system we're proceeding with. Just out of the box, we found with an implementer, and we thought that was who we will probably go with. We involved a consultant from Ray, that they helped us find, Rowan Company, which was a blessing for us. He helped us find another implementer that's using the same company we found, which is the Microsoft Dynamics Business Central, but with an add-in that adds a lot of capability in our industry. It's called Real Steel. So even though we found the same ERP company, with help from a consultant, we found something that adds a lot of capability that we're sure we wouldn't have found by ourselves. I just encourage everyone to get somebody that's in that field to help you do that. Another thing we found important in the research was to get the providers to show you not just tell you, yes, we can do that. They'll all tell you, yes, we can do that, we can do that, we can do that. But if they show you on the screen, you'll ask different questions. Just a couple providers, we had as the person doing the demo wasn't overly familiar with the software, and as they were typing the search bar trying to find a report or something, they had to spell the report. Let's say there's production, they had to type in PROD and then hit search, it found it. Current software, they can type PORD and spell it incorrectly, and it still finds it. Just some of those little details as you look at the software, watch the software, it makes a difference.
Can I pile on to what Mike said?
Yeah, go ahead.
That what he just said about making them show you that it meets your criteria is really important. So we were scheduled to go live in January of 2021, and we delayed it a whole year, so January of 2022, and it still wasn't where it needed to be. Now, time's complex in that we have retail, logistics, distribution, and manufacturing. And we couldn't find anybody out there that did all of those. So the company we went with had to develop the manufacturing piece. And that was one of the areas that really fell short in a big way. But the company that we went with does 35 to 40 installs a year. So they want a date for them. You set a date, you work like crazy to get this thing ready to go. And whatever you got on that date, you go with. We're never going to do that again. And we delayed it a year, and it still wasn't ready. So what he just said, so now we've developed 8 principles that we now are going to use going forward. And when we sit down and talk to somebody, the first conversations with these 8 principles, and can you buy into this? And one of them is what Mike just said, which is show us that it works, and then we'll set a date to go live.
Thanks for adding that. I think you can see how valuable doing that research up front, and also we haven't really touched on phases, but really defining what you want in each phase and not scope creeping. So yeah, we want all the bells and whistles, but maybe that's phase 3. If you're talking about it in phase 1, you're going to lose traction and you're going to get off track. So really defining your needs and wants and what do we need right now versus maybe what do we want 3 years down the road.
Can I follow into that too?
Please do. Yeah.
So another one of our principles is now a minimal viable product. Because we did exactly what you said. We just plowed on, and we tried to implement a WMS system at the same time we implemented a new ERP. And then we just kept adding to it, and people all across the company say, well, I'd like this and I'd like this. So we had this monster, and it was debilitating when we went live. And so now we talk about a minimal viable product. What's the minimum we need to get started, to make the change? And then we'll add to over time. So
speak to that as well.
Yeah, please
It's
do.
the exact same process we've been going through is we call them scripts or business scenarios, however we want to call them. But just do that. There's a checklist for each department that the department head helps the project leader determine. These are the 10, 15 items. If the system can do this for me and my team, we're going to be satisfied with this. And we're both clear we have a phase 1 and a phase 2 that we've created in the research and the early implementation phase. So not just the vendor, but also our team, if we talk about change management, and so the expectations meet what we're expecting, what the vendors are expecting, to have that clear from the onset.
maybe we should hire you for our consultant, Mike.
I'd like to add to that.
Yeah, please do.
We've talked a lot about being proactive and planning and having documentation, and I think all of that is phenomenal and is needed. I think his MVP concept is spot on. We find we get more feedback and anticipate more of the scenarios and the watchouts and the things that we didn't consider in that 350 or 360 hours leading up to it when it's actually in the user's hands. And so what we try to do as much as we can is, what is the MVP? And let's have a subset of the company or the department actually walk through it in their day-to-day and do it in parallel with what they do normally. And when you do that, you get feedback to say, you thought it worked this way, but it actually works this way. And I think that MVP approach is spot on.
One thing that's helpful also is to have each department represented in the project research. So each department is doing what Colin said from a minimum standpoint. What do you actually need, and show the software. We did that. We asked demos from each of our multiple vendors we were looking for with each department. Is this what you think you need before we decided what system? And then the implementation isn't that complicated. We're both confident. We have a checklist. We know what we need.
Can I add to that as well? We've completely flipped on its head. Our ERP implementation was driven by our IT department. And we've completely flipped that to say operations is going to drive changes to our ERP system. And our IT folks are there to implement and support that. And that's a huge switch, because our IT department, none of them are here today now. We've talked about this. They made some decisions from a technical perspective that weren't necessarily the right decision from an operational perspective. And again, they're great people. So, everybody was trying to do the best. But that, and one particular decision in particular, would not have been made if it would have been driven by operations. So now operations is designing the process, the flow charts, that type of thing. And they're, in essence, it's a partnership, but they're much more in a leadership role of what our Go Next 2 is.
I'm going to add to that just a little bit. We talk about making sure that operations is involved, and that's critical, but you also need to make sure you have all levels of operations involved. So it can't just be your shop supervisor, your managers. It has to be the people that are going to be entering the transactions or doing the entering on the floor. They've got to be involved. They've got to say, well, this happens every day. How do I do this type of transaction?
I'm going to pause. Are there any questions in the audience so far?
Experience ERPs. How do we get a buy-in? People that are actually basis. Some time recreating what's already in the existing system. The leveraging automation process.
Rex.
I'm going to date myself a little bit. You can probably tell just by looking at me. So back in the 90s, ERP systems were just kind of coming about. The story I heard was year 2000 drove a lot of that development. I remember when we had massive IT departments and computers, and they didn't talk to each other, and every request to IT was, oh, we're going to have to do a report, and that's a whole project, right? Some of you might remember that. ERP systems came about. MES systems. They're floating around out there. Like if someone can comment on MES and ERP. I heard the other day, oh, MES, that's kind of old now. It's already being built into the ERP systems. And then we have CRM, and then we have QMS, and then we have WMS. Any perspective on, because when you just say ERP, are there ERP systems that we can go out and do ERP and cover many of these other areas? Are we looking at additional solutions?
Can you say what MES stands for?
Manufacturing Execution System. Specific to the production.
So another one of our principles is our consultant told us we should buy one system to solve all these issues. And he was a really good guy and really smart guy, but that was the wrong approach for us. So we're looking at best of breed in a number of areas. And then our IT department is in charge of the integrations. Is that getting at your question? Is that kind of what you were asking?
Yeah, I mean, I do believe there are both ERP systems that have MES functionality, CRM functionality, that support quality systems. There are other systems that don't. We're going to have to bolt on or add on.
And what you usually get, like our ERP came with a CRM, but not a really robust,
Not a real one,
not
yeah.
meeting our needs. So, we went out and we're now on Creatio, and we're gonna be bolting a variety of best of breeds together, and with the communication, can't think of it, with APIs. Thank you. Today they play together well, and so then that becomes a key role of our IT department to make them talk together. So the one size fits all, usually you get a bunch of mediocre kind of.
I would agree, and I think a lot of systems are out there they're adding modules all the time because they want to keep you in one ecosystem. I think as Jim mentioned, we'll work with clients to exactly how Kime is going about it. We want this CRM because it's best in breed. This warehouse management system is better than what we got, and we want ERP to be these core functions within our processing. So every offering out there is going to say, yeah, we've got a CRM. I think back to the point that was made earlier, go through it, see how robust it actually is, and if it meets your need. And if it doesn't, then because we have the ability to connect these systems together, that's certainly an option today more than it was in the 90s.
I would second that. If you're crystal clear from what Colin said earlier, if you have clarity in what you need, it'll become obvious if one system does it or you won't.
Can I make one comment on best of breeds? Definitely look at other things, because when you go to a software or ERP, it doesn't fit all your needs, right? But one risk of a best of breeds is when there's upgrades to that ERP system, and we had it at Smucker's, it breaks all those tables. So that's the only risk, that there's some upscale, but that you'll have on the front end to build those tables and those integrations to make them work. But the best of breeds is the right way to go when it doesn't fit it, right? Like you have to look outside the box of Oracle. Oracle didn't have the best, order management system, so we didn't go with them. We went with other company. But just the risk to call out is if you go to best of breeds, there's an upgrade. It's just a little bit more upfront work.
Well, and I think maybe to pile onto that, be aware of how much you're customizing in the system you're buying. Okay, so a lot of times folks grab a system and they say, well, this doesn't quite what I need it to do out of the box. So internal IT is going to customize all this stuff. Well, if you're playing in their sandbox and they change one thing on their side, now you got a lot of Frankenstein code that you have to figure out. And so I think, making sure that if you are going to select a system, try to play within their sandbox as best as you possibly can. I think these bolt-ons are great, but it's when you get into customizing on top of the solution that you've selected that you run into a lot of issues, especially long term.
I kind of want to veer off into a little bit different, but I know we have a wide variety of business sizes here today. So we talk about ERP, and we can maybe talk about kind of the larger businesses. A lot of what we're talking about with these principles, it's about change management. It's about recognizing what are your needs. So if you're sitting here today and you're saying, well, I just use QuickBooks, I'm not ready for Oracle, these principles still apply. They still apply with, is it time to upgrade QuickBooks? Maybe you're just looking at a QuickBooks integration. And the number of times I've sat in meetings and I've heard clients, usually they call us about 2 months after they went live with the system, and they're like, it's not working. And I said, well, why did you switch to the system? Well, I don't know. Somebody told us it was a good system, but they can't tell me why they, what their needs were. So we're talking a lot of change management, and that doesn't matter. That's important no matter what size of a company you're looking at. And these principles about software selection, even if it's a third-party app, they're still critical. They just might be a little easier because there's usually less people involved and a little bit less dollars sometimes.
And to that point, I think we're very quick when the system doesn't meet our current processes. Let's customize it. Let's change the system. Instead of looking at, can we do this different internally? Can we look at a different way of doing what we're currently doing? And we're very quick to customize, change the system, but it all goes back to change management. What can we do differently? Can we think of a different way to do this? How can we change? So speaking to change management then, what have you guys seen that's worked well, or maybe what have you learned along the way that maybe you wish you could have done better?
Tons. The people side of this is very much neglected. We tried to prepare our team. I used the metaphor of the children of Israel leaving Egypt and going to the promised land. And our old system was Egypt, and the new system is the promised land. And you're going to be in the wilderness for a while, and you're going to want to go back to Egypt. You're going to want to go back to slavery. Of course, the 40 years wasn't part of the metaphor I wanted to emphasize. We talked about that a little bit, but we, nor the company we were working with, didn't do near enough focus on this. So as soon as we went back, I said to our people development person, I said, we have a whole process now. We're going to work with individuals to help us become more comfortable with change, to be more self-aware about ourselves in change. And so we're using strength finders across divisions, and we're going to put 40 to 50 people through that in the next while here as we prepare for the next step. And that's been really helpful for people to self-reflect. And there's been some really interesting trends for us. We're way overrepresented in this one area that has to do with perfectionism. And that's part of our issue. Part of our strength at Keim is that we have this tremendous customer service. And yet that perfectionistic approach to that is a positive. But when it comes to change, it's not a positive. So how do we be more self-reflective as leaders in our organization to recognize when we're just simply not doing well with change? So I can't emphasize this enough. And the software companies aren't going to spend a lot of time with this. I don't know about you consultants if you're going to push a lot on this, but you need to really think about that. How do we prepare our people for change? And so for the next round of change that we're going to go through, we're going to be at a much different place. It's going to be tough. Anytime you change the ERP, it's always going to be tough. But don't underestimate people's side of this. That's a big lesson. And then I'll say another one is, as leaders, you need to be you need to be non-anxious through this process. I remember there was one morning I got up and looked in the mirror and said, "You look awful today. Don't go to work this way." But it wasn't very often that I felt that way. I mean, it is just going to be a tough time. But they're looking for you for cues as to where this is headed and how this is going. And so you have to self-reflect. You have to prepare yourself during this time. How am I going to be during this time that people are going to take confidence from?
I think we could just take Colin's first 10 minutes of the presentation that he did earlier today and drop it in here. But there's two things that come to my mind. First off, tell your why. Why are you doing this? And this can be big picture. Why are we making this change? It can be little things. Why do we need to track this? Why do you need to click this button? Why is it important? If it causes problems down the road, if you explain why that data point is important, it makes it a whole lot easier for the users to remember to keep on with that instead of just thinking, oh, it's one more place I have to click. The other thing that I would say is when we look at change management, remember that as a leader, you have thought through this process. And so when we look at the change curve, you're going to be over here and you're saying, okay, I know where we're going. I know what's happening. I know, you've already processed what this is going to do to your day-to-day life. A lot of your employees, they're right at the beginning and they've got that scared cat look, right? So they're saying, I can't do this. Or maybe they're in the depression and you're up here. Remember that they're behind you on that curve and make sure that you acknowledge that and recognize where they are at.
I think it goes back to you're changing mindset, not technology. And, I didn't touch on a ton in the intro comments, but when you get into that valley and there's chaos and people are squirming and it's, why did we do this? Over communication, and I mean over communicate. Like if you think you've said it too many times, you haven't said it enough. That to me is critical, not only at the leadership level, but to all levels of the organization. So what we try to preach is, I think StrengthsFinder is great. There's a lot of tools out there that helps us know who is the audience we're communicating with. How are they going to receive the message? Because the message and how it's delivered is just as important as everything we're talking about here with systems change. So over communicate. I cannot say it enough. The more you can get in touch with folks, and I think it's a two-way street there. I mean, it's okay to have forums to say, how are you feeling about this? We anticipated one thing, we're seeing something different. Are you feeling the same way? Are we overreacting? Being vulnerable in that situation, I think, is key.
Can I piggyback on that? So we had a change management team and they communicated every week, status, what was next. So like everyone was getting the same communication and know what was going on. So no one was in the dark and that we were all trying to get on the same page. So I don't know if teams are big enough, but have a change management team that kind of focus one or two individuals that can focus on giving that message, that communication out. Because again, it's a journey. We're all in this together. There's going to be ups and downs, peaks and valleys. But as long as they're in the know and they're aware of it, we can all go together, hold hands, and hopefully we come up on top. That's how it worked with us. But we had a lot bigger organization, but it's still the same. You can still go at smaller scale and still do that over communication. That's what we did.
I think it depends on the size of the organization, but if you are bigger, we like to have different champions in different departments. So that way they're the ones that are kind of in the thick of it, in the heart of the project, but they're able to distill and cascade messaging back to their teams. I'm a big fan of email, but I'm much bigger fan of in-person seeing faces, because you cannot interpret text. You don't know the emotion behind the text. I mean, we can do all caps and exclamation, but at the end of the day, having that face-to-face real life conversation, emails are great to just say, hey, everybody's getting the same message, but make sure that you spend that time in different groups and with departments to say, how are you actually feeling about this? Because this is a big piece of the puzzle, is what is the emotion or the morale of the business as we implement?
I'd second that. Just somehow have to draw the emotion from all the way in the frontline workers all the way to the top. It's not that important how you do it. Is it an email once a week? Is it a meeting once a week? Is it a meeting every day, every morning, if that's necessary for a while? Just so you give everybody the opportunity to express their frustration if they have frustration somewhere. Some people that takes a one-on-one. Some people it's fine in a group setting. You have to identify that and do that. That's important.
That's a great point. And I've heard at times too, you sit there and say, are there questions? There's people that might speak up and there's people that might need a day to process and think about it. So are you going back to those people and giving them time, knowing your people and saying, hey, do you have any thoughts after yesterday's meeting? Because there might be quieter individuals or ones that are going to speak up and ask questions. Don't leave anything on the table. Don't leave anything left unspoken. Is there any other questions in the audience right now? What does success look like? The beginning of an implementation, are you saying, this is what we're going to define success as? Yeah.
Sure. So when we sat down with our provider in our kickoff meeting, or when we sat down with them after we said, you're the guys we're going to go with, we created a list, two things. One is a checklist of the tactical things we need done. That's what I was talking about earlier that they actually showed us they can do. So that's the one task that needs accomplished in order to be successful. And the other was some more high-level goals that might be a little bit harder, not quite as tangible. For us, it might have been a specific thing from showing, we have multiple brands within our company, to showing more data financially, operationally, by specific categories. Is it customer? Is it brand? Is it item? A couple of those items, a couple of those goals written down. It's in our repetitive meetings every weekly. That's on our agenda at the top, so we know this is what we're working for. This is the goal for our implementation. It's in front of everybody. That's how we did it.
In some ways, it's again depending on the size of the organization. Business continuity at the start is something I think is a huge success. We've seen companies go into tailspin when there's just a lot of chaos and wait a second, we don't even know how to serve our customers at the end of the day. So I think just being able to have consistency in the operations and in the flow of what we're doing, business is not being disrupted from that standpoint. We look at that as a success criteria, but I mean, I think part of the exercises that we'll do with clients is give me best case, give me worst case. Right. And sometimes being able to paint the extremes allows us to frame in. If we land somewhere in the middle, that's good. If we can land best case, then that's even better. Worst case, at least, is known. Right. And worst case, I think, is when we get into things like business disruption or people leaving and leadership turnover, all of those things that you want to avoid. Just having at least those guardrails in place, I think, are important. At the end of the day, though, we're trying to influence behavior and influence action. So the system is great, but ultimately knowing, and I think Andrew touched on it in his slide as well, how we make decisions differently going forward as a result of this change. And if we have quantified that up front and we know it, and then we're actually starting to live that out, that to me is success with an engagement with the client. And I should also say, I hate the word consultant. Like when we go in, it's just got such a bad connotation with it. Because there's a lot of consultants that come in and they reuse the same slide deck from the last presentation. You're like, oh my gosh, these guys again, right? We really try to partner with companies in a way that in a lot of times we sit on their leadership team. Now, that may not be a sustainable model, but it's one that allows us to actually get into the business, understand what they're going through, their pain points, how they view the world, and then we can be a collaborative advisor in that sense. So I think as you evaluate anyone who's a consultant out there, see what skin they're willing to put in the game and how far they're willing to take it. You know, are they willing to sit there and have the conversation with employees that are struggling, and can they be there as a safeguard and honestly another spokesperson for your organization? So all that to say, I know that's long-winded. Success is we've changed behavior and we've done it in the way that we thought we would.
Again, my thought to this question was, you know, if you have success, but I would broaden that out a little bit and say, you know, you can have day one success, and then you need to think about long-term success. So day one success might be, can you continue business operations? Can you pay the bills? Can you receive money? Can you ship products? Long-term success, I think, gets into better decision-making. Let me back up a little bit. I should have prefaced this. That initial conversation about what's in phase one, what's in phase two, sometimes we call it phase now, phase next. If you know what is phase now and you've defined that, then you have metrics that you can go back to and say, did we meet these goals that we had? Were we able to accomplish this? If that's nebulous, where, okay, we just need a better system, it's really hard to determine, did you actually succeed?
I think the only measure for me is, does it help our employees serve each other and our customers better? And a company brings in a system to Charm, and one of the things they sold us on the WMS system was that you can hire a 18-year-old, train it for 2 weeks, and they can do the job. Warehouse management system, or what came known as "Where's my stuff?" So we have people that have been with us for 25 years loading trucks. They know how this builder likes a truck loaded versus this builder likes a truck loaded. And the system completely undermined the knowledge and experience that person brought. So as an 18-year-old could do it just as well. That was perceived by the company that brought this to us as a plus. And that didn't help us serve our customers better. And as I said earlier about a minimal viable product, one of the things that WMS got rid of all the paper. For example, most of the paper. We're probably now going to keep paper for a period of time and maybe for a longer period of time. I just want to really challenge you. If you're not getting this to make your service to each other better and to the customer better, at many points along the way, I think you're doing it for the wrong reason. Information overload. How much information do we need to manage our business? And that's the promise of these systems. But we don't even need a lot of that information if we're taking care of each other and our customers well. So we used our mission statement multiple times in meetings, and I put it up on the board and said, are we getting there? And we weren't. And we were starting to lose customers, and we were going to start to lose a bunch of employees. So, but you know, we had a bad example. We had a bad experience, and I'm assuming most of you won't have a similar experience like that. But I'm serious about focus on employees and customers and serving them better. That should be your motivation for a new system.
We've talked a lot about change management, so you can't use that as an answer to this question. What is other big hurdles that you face for implementations?
I don't think I can speak. We're only partway through implementation, not far enough that I'd say we face many hurdles.
Have I scared you yet, Mike?
You can speak on that.
Let me say it this way. There's always going to be something unexpected. Right? We didn't realize this user group was going to do it this way. We didn't realize that this was going to be the impact of implementing that. I think paper is a good example. We had a company that wanted to go totally digital, where everything's going to be on monitors. they're still in paper as we migrate to monitors. So, kind of going back to anticipating the journey, you can try to anticipate things, but there are going to be hard decisions that come up. There are going to be key people that leave the project. There are going to be leaders that say, I'm not really bought in. This isn't what I want to do. The 30 years of what I bring to the table, you're trying to upend or get rid of. And having some of those conversations and dialogue with your leadership team, I think is one area that, sometimes folks feel exposed. And they feel like, hey, you're coming into my area. You're now getting real-time insights and you're questioning me about the things that are happening, but you're not there. So being able to just anticipate some of those conversations, as I said earlier, that would be the biggest watch out, is things are going to come up that you didn't expect, and being prepared, staying level-headed, and making sure that in those moments you are truly leading. I think it's important.
I kind of had the same thoughts. I think the biggest thing is it's about leadership. It's about your culture. So, this is going to test your team like few other things do, depending on the size of your organization, the size of what you're trying to implement. So making sure that your leadership is fully engaged, realizing that most of our team members still have their day-to-day jobs to do in addition to trying to figure out this new system and to test it and to figure out what works. That's an enormous stress. So making sure that you have a culture where your team members can be candid, where they're willing to speak up and say, hey, maybe I need a break for a day or two. Maybe whatever that is. But as a leadership, making sure your leadership is in touch with your team members. And this is probably the extreme, but not having your C-suite of leaders walk the shop floor and saying, oh, I can't handle this. Look how many hours we're wasting on this project. But they've got to be engaged. And that culture starts at the top.
I really like your point about helping people be able to speak honestly about that. One of the things in our culture around charm is people will say, well, who am I to say? It's part of the humility that we have there, which is a good thing in some ways. But when we were having this meeting on whether we were going to go back or stay the course, my job was to try and make sure that the truth was coming out, like that everybody could be a truth teller. And I think that's to your point. And how do we as leaders elicit that? And somebody said something in that meeting that I didn't really appreciate in the moment, but it was really important. And I'm really glad that they could say the truth, and it changed the course of the conversation instead of our going back to our old system. And so we have to understand we're the elephant in the room as leaders, and we have to ask for people to be honest over and over again. Like we have to ask over and over again and listen over and over again for what's really going on, because they want to protect us. They want to tell us what we want to hear. So if you have an organization, if you have a culture where the messenger gets shot, that's going to make it really tough for this type of thing. So I look back now and I said it's really grown our muscle as an organization. I think we're a lot better for having gone through this. It was tuition. There was a lot of tuition money spent. But I'm serious about that. I'm really glad for it now, because the Kine family wants the business to be in the family for another 100 years. And so this is just a blip. And we now have learned so much. And the other thing I would say too, I think one of the mistakes we made was we had key operating people on the core user team. We call it our core user team, the team that was really driving this. And they were trying to manage their day jobs as well as this, and that was way too much to ask. And so going forward, we're developing this team of process engineers and business intelligence folks in the operating divisions, and they're going to be the ones leading that change. And our key managers are already feeling less stressed about what's coming next, because they understand they're going to get to keep their day jobs. Certainly they'll have some of this, but that was a mistake to have that kind of a dual role. So how do you create a culture before you go into this change where people are free to say what they really believe, and what that's a big one.
Are there any other questions out there yet? I know this is a hard question to answer, but we get it a lot. How long does an implementation take? And usually it depends, but try to answer that question, because we do get that one a lot. What can people expect?
I'm glad I can't speak to
We've seen, we're doing a really aggressive one. We have to for business reasons, but we're going to do a 90-day sprint. It's with 10 folks, so it's not as big. We've seen organizations that have taken 8 years. Now, I've not been a part of that. I think the question is, what is your appetite for how long it'll take? Because again, this is about culture. This is about transforming business process, transforming mindset. And that takes time. And if you look just rough averages, it takes 2 to 3 years to change a culture minimum. Think of it in the same vein as you would with changing a culture as how long it takes to implement a system. I'd like to say it's a couple years. Sometimes it goes longer, sometimes it goes shorter.
Oh, can I add something? So typically when we did our acquisitions or integrations, it took about a year. So you do all the diligence first, like how they do things in their system. So a lot of companies we acquired, they had Navision, they had SAP. Most of them were on Oracle, so it wasn't easy where we were in Oracle. So what we did was do all the diligence, kind of how they do from beginning, from direct material receiving, production reporting, variances. And then we worked with teams. So on the floor, shop floor teams worked their teams, but it would typically take us a year to initially do the diligence on how they do things and then figure out how it's going to work in Oracle. And then is there any gaps? So like some things they did in SAP, our system in Oracle, we didn't have it built. So we would communicate them, are we going to build something customized, or are they not going to have it, and how that's going to work? So that change management was sometimes difficult, but we would put them in, go a year, and take about a year to do it right, all the testing and whatnot. And then after we went live, we would support them 3, 4, 5 months. Like DLX, WMS, warehouse management systems. Folgers had their own, P&G had their own system. Well, we brought in WMS. Well, we had inventory issues when we went live that we had to deal with to make sure, that's the bloodline of your manufacturing is your inventory, to make sure that things were right. So we supported them. I was on the phone with a warehouse manager for 4 or 5 hours a day for the first 2 or 3 weeks. That's what I did because they were so behind, but I was there for their safety net to help them. Because if we weren't there to support them, again, it wasn't working like before, and they were used to what they were. They used many years. So I say it's a good 6 month to a year if you're doing it right. You don't want to take any shortcuts. You take shortcuts, you get burnt. I mean, that's the thing. You always test. We always said that. Hershey's, I don't know if you guys ever read the article on Hershey's when they went and did their ERP. They tried to do a shortcut. Well, they lost millions and millions of dollars because they couldn't receive orders in because they didn't test. So like, I wouldn't put a specific time. Get what your needs are, your wants, and then build it out and do it right. Because if you try to go fast, I mean, there's times like that Colin said you have to, but I wouldn't take that risk. I would make sure you do it right because that's your bloodline of your manufacturing operations is your ERP system. Orders, you can't get orders. Customers can't see it. You can ship it and then you'll get your paper and pen out and then record it, but that's not going to last long. So I would say there's not a specific time, but 6 months to a year would I would suggest.
I would also add, make sure that you have ways of measuring if it's going well. Sometimes you walk into clients and you just go out on the shop floor and you realize it's total chaos, and they don't really know that.
Yeah.
So being able to have measurements in place of what are we checking for along the way, regardless of how long it takes, having visibility to that is key.
So kind of to that point, as I was listening to the conversation, I was sitting here thinking, we often ask how long, and what we're really asking is how long to go live date. But I think we need to shift our perspective a little bit and say, okay, we're embarking on a journey of continuous change, continuous improvement. So you're going to have milestones, and go live is simply a milestone on that journey. Because if you go live and then make no more changes, you're going to have the same thing if it lasts 10 years, you're lucky. But think of this as a milestone of completion, and know that there will be continuous changes that you need to make. Organizations change, business change, our environment changes. So I think we need to be careful if we give our team a date and say, okay, this is our go live date, and after that life will get back to normal, because normal is not going to be what we currently define as normal.
And I would add, when I asked them what defines success, they didn't say, we set a date of a year and we met it. That wasn't what any of them said. You know, they said it was, we met the goals that we wanted to meet. So really framing that, that's good. Thank you guys. We're running low on time here. So just my last question. What's something that I didn't ask that you guys wish I would have, or something that you want to share that you didn't get to today? We covered it all, huh?
No, there's one thing going through my mind that was very important for us. Just thinking that was the. I thought I had it here.
He's thinking about that.
Yeah, go ahead.
There's been a lot of focus on the system, whatever the new system or technology I'm putting in place. We find a lot that it's helpful to just make sure that baseline computer skills are where they need to be, even before the system goes in place. We're talking navigating screens, being able to understand, because if you build some of those fundamentals and then put them in a new system, it's easier for them to transition. If you have somebody who's not very good on a computer today, and then you put into something totally different tomorrow, not having any bridge to get there is overwhelming. So there's a lot of good online tutorials that would even just kind of prep folks for, here's how we use Microsoft, or here's how to think about a computer, especially in manufacturing on the shop floor. Just getting introduced to a tablet or a computer itself, having some of those building blocks in place, I think is important.
Great, Colin.
Finally came back to mind. Anyway, with having a good implementer that your internal implementing team is comfortable with. If you have a team that you're depending on to set up a system to run your business on and you don't like them, it probably won't go well. So make sure you like your implementation team and you know who they'll be before you sign the contract.
Does your brother like you? I like Cheryl's comment about continuous improvement. And one of the things I love about the Holmes County community is we love to hack. We love to hack things and to constantly make things better. And I think that's part of the Amish Mennonite culture. And my dad was that way. He was always trying to fix things and make them better. And so technology that allows us to continually improve and make things better based on the ideas that our people have. That's something that we certainly want to make sure we allow for going forward. So that continuous improvement idea, it's never finally installed. We're always going to be trying to find ways to make it better. And one of the things we've learned is that if someone says it's the best practice, we raise a yellow flag. Because best practices that work in Austin, Texas, or Denver, Colorado, don't necessarily work in Holmes County. And so I would be cautious about that. We do business differently in Holmes County and Wayne County than what a lot of places do. And so let's just not take on the technology and assume it's going to work how we need it to work.
One thought that came to my mind is it worth it? Implementing, doing change, technology, it's a lot of work and it's scary. But I think if you're sitting here and you're saying, what do I need to take my business to the next level? What do I need to make good decisions? And I loved the idea of what helps us to serve our customers and our people better. If that needs to frame our decision-making process on why we do this, because it is going to tax our team. It's going to put a lot of stress. But if we can sit here and say, this is hard, but we will be a better company that meets our goals at the end of the day, then we can sit here and say, yes, this is a decision we need to make.
And I think it's at the end of the day. I certainly understand that in an ERP install, we're not always going to serve our customers great every time. But the idea is that the goal is to serve each other and our customers better. Understand there'll be some glitches along the way. I have plenty of those stories to tell.
Jim, if you weren't faced with the fact that your software is no longer going to be supported, knowing what you know now, would you still go ahead with the new system?
Yeah, it would just be in a very different way. Like it wouldn't be the system we went with. as I said, because the manufacturing piece was way underdeveloped, and we tried to do WMS and ERP at the same time, and that was our mistake. And that was just way too much. So, yeah, I mean, we, as one of the reasons I said for the change is that we want a better system. Our system is outdated. We want a more modern system, better information. So yes, we are going to change, and we're looking forward to better systems for us.